To order. Without objection, the chair is authorized to declare a recess of the committee at any time, and all members will have 5 legislative days in which to submit extraneous materials to the chair for inclusion in the record. This hearing is for the purpose of receiving the semi-annual testimony of the Federal Reserve's Supervision and Regulation of the Financial System. I now yield myself 3 minutes for an opening statement. Today we are very pleased. I'm very pleased to welcome the Honorable Randy Quarles, Vice Chairman of Supervision for the Fed. We have been waiting, Mr. Quarles, 8 years for your arrival. We would like to know what took you so long. I think what we know is under Dodd-Frank, the statute says the president shall appoint a vice president of supervision, not may, and yet President Obama refused to. We all know that Governor Tarullo de facto filled the position, but he did it without oversight and without checks and balances. Fortunately, President Trump has a very different view of the statute, Constitution, and his respect of Congress. We all know that today, Governor Quarles is appearing on tax day. And we also know that thanks to the President and Republican Congress, we now have a 3% growth tax code. We know that 90% of all Americans are now receiving better take-home pay because of this act. And people are seeing pay increases, 401k increases, and job expansion all over the nation. That's the good news. We may have a 3% tax policy in America, but we do not yet have a 3% capital markets and banking policy in America. And we need one. 3% growth makes a huge difference in the lives of our countrymen. Since the time that I have been on the face of the planet, a little over half of the years have seen 3% growth, and a little less than half the years have seen less than 3% growth. In those years that have seen 3% growth, 4/5 of all the jobs that were created in my lifetime were created in 3% growth years. Poverty fell by almost 3/4, and real median household income grew by approximately $20,000. In the years since I was born, where the economy grew less than 3%, only 1/5 of the jobs were created. The poverty rate rose by over 1/3, and household income fell by over $10,000. For the average family in America, 3% growth is the line of demarcation, which determines whether all their work and sacrifice for the year will actually translate into getting ahead. So it's important that we get it right. And we all know that Dodd-Frank, regardless of what it may have done for financial stability, is perhaps the most complex, costly, confusing regulatory onslaught onto our capital markets that we have seen. Many market participants, in fact, believe that it has cut 1/2 to 1% of GDP. That's why, Governor Quarles, we very much welcome your call for efficiency, transparency, and simplicity in regulation, because we also know that in a post-Dodd-Frank world, the Fed is now our uber financial regulator, and I particularly appreciate your call for efficiency to make sure that the net cost of regulation in reduced economic growth or increased frictions in the financial system is outweighed by the benefits of the regulation. To quote you, I look forward to hearing more in your testimony. The chair now yields 4 minutes to the ranking member for an opening statement.
Thank you, Mr. Chairman, and welcome, Vice Chairman Quarles. I look forward to hearing Vice Chairman Quarles' testimony today on the Federal Reserve Bank's supervision and enforcement activities. I want to point out that the position of Vice Chairman of Supervision was created following the financial crisis as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act, as one of several steps to address the Fed's insufficient supervision and enforcement leading into the crisis. Vice Chairman Quarles is, in fact, the first person to officially hold this important role that is critical in keeping our financial system safe and sound. I was encouraged when the Fed took action under then Chair Janet Yellen and initiated a strong enforcement action against Wells Fargo for its egregious consumer abuses and cap the bank's growth until it cleans up its act. Of particular significance is the fact that this enforcement action is not just a fine, but comes attached with real consequences for Wells Fargo, which is a repeat offender with a terrible track record of harming consumers, including by opening up millions of fraudulent accounts without their customers' consent. I hope to see the Fed continue to strongly use its enforcement tools. We need our independent regulators to be vigilant in carrying out their statutory duties and make robust use of their authorities to crack down on bad actors. Sadly, that independence is under attack. Just last week, Office of Management and Budget Director Mick Mulvaney, who was unlawfully appointed by President Trump to serve as acting director of the Consumer Financial Protection Bureau, testified before this committee. Mr. Mulvaney's illegal appointment, there have been 0 enforcement actions by the Consumer Bureau since his appointment. And he has taken a series of actions to weaken the agency's ability to carry out its important mission and benefit the predatory actors that the agency is designed to police. Indeed, the Trump administration and my colleagues across the aisle are working to move our system of banking regulation in exactly the wrong direction in their efforts to dismantle the crucial reforms that Democrats put in place in Dodd-Frank. These efforts at deregulation come at a time of record bank profits for banks of all sizes. But even though the banks are making money hand over fist, this president and Republicans in Congress are pushing hard to help out the nation's largest banks. Nearly every week, Republicans push through harmful legislation that undermines Dodd-Frank. I'm also very concerned by the recent proposal from the Fed that would lower the capital buffer at the 8 largest banks by a combined $112 billion. Under this proposal, Wells Fargo, for example, would be allowed to hold $20 billion less in capital than the current standard for a well-capitalized bank of its size. I look forward to discussing these and other important issues with Vice Chairman Quarles here today. And thank you. I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, the chairman of the Financial Institutions and Consumer Credit Subcommittee, for 1 minute.
Thank you, Mr. Chairman. Vice Chairman Quarles, welcome. As we all know, the Federal Reserve Board was without a designated vice chair for supervision for almost a decade. With your appointment, that position has finally been filled, and we are pleased to have you here today, Mr. Quarles. Welcome. Since your initial confirmation in October, you've made many statements outlining your agenda and your intentions. I wholeheartedly agree that it's time to step back and do a comprehensive examination of the previous administration's regulatory regime. Looking forward, there's an immense amount of work to be done. As we assess the Federal Reserve's role, we must ensure a more practical approach to supervision, one that extends from the top all the way down to each and every field examiner. We also need to ensure the Federal Reserve adequately and appropriately tailors its supervisory approach on an institution-by-institution basis and puts more thought into the manner in which it regulates and examines. I'm confident you will make the critical changes needed to benefit our economy and improve the stability and productivity of our financial system. Look forward to your testimony today. With that, Mr. Chairman, I yield back. Welcome.
Gentleman yields back. The chair now recognizes the gentleman from Michigan, Mr. Kildee, the vice-ranking member, for 1 minute.
Thank you, Mr. Chairman and Madam Ranking Member, and Mr. Quarles, welcome. We appreciate your testimony today. I've been an advocate for pushing our federal government at every level to focus more attention on the struggles that America's older industrial cities, old cities and towns face, many of them that continue to be left behind even during periods of economic growth. The regional banks have done some interesting work in this space, particularly the Cleveland and Boston banks recently, but the Philly and Minneapolis banks have also focused some attention on this. What I'm interested in hearing from you are any thoughts you have about how the supervisory authority of the Fed, the levers that come with that authority, can be used not just for the purposes of streamlining the regulatory process, but those levers could be used in ways to increase the efficiency, the efficacy of the Community Reinvestment Act, access to credit, essentially trying to use the tools you have to ensure that there's equity in the way the financial system works, particularly in those places with high unemployment, high levels of poverty, like my hometown of Flint, Michigan. So thank you for your appearance here today, and I look forward to your testimony.
Time of the gentleman has expired. The chair now recognizes yet another gentleman from Michigan, Mr. Huizenga, the chairman of the Capital Markets Subcommittee, for 1 minute.
Thank you, Mr. Chairman, and happy tax day, Vice Chair Quarles. I would use air quotes, but for many of us, we believe that this is the beginning of a better situation. As the former chair of the Monetary Policy and Trade Subcommittee at oversight of the Fed, I watched very closely as the enactment of Dodd-Frank supercharged the Federal Reserve, bestowing on it even more power, influence, and control over the financial system, all while remaining shrouded in mystery to the American people. That is something we hear consistently, is people don't understand what the Fed does. Specifically, Title 11 of the Dodd-Frank Act created a new position of the Vice Chair of Supervision, and we're very pleased that you have taken that position. On February 22, in a speech that you gave, you mentioned that the Federal Reserve and other regulatory agencies have completed the bulk of the work of post-crisis regulation, and I quote, "As such, now it is eminently natural and expected time to step back and assess those efforts. It is our responsibility to ensure that they are working as intended, and given the breadth and complexity of this new body of regulation, it is inevitable that we will be able to improve them, especially with the benefit of experience and hindsight." Well, Mr. Quarles, as had been noted, we've been waiting a long time, and I appreciate this thoughtful, retrospective view that is happening as we drive this economy forward. I yield back.
Time of the gentleman has expired. Indeed, today we now welcome the testimony of the Honorable Randall K. Quarles, the first Vice Chairman for Supervision at the Federal Reserve. Pursuant to Section 1108 of the Dodd-Frank Act, President Trump nominated Mr. Quarles to serve as Vice Chairman for Supervision, and he became a member of the Board of Governors of the Federal Reserve on October 13th of last year to fill an unexpired term. He was sworn in as Vice Chairman for Supervision on October 13th, 2017 for a term of 4 years through October 13th, 2021. Prior to his appointment to the board, Mr. Quarles was founder and managing director of the Sinosure Group, a Utah-based investment firm. Before founding that group, Mr. Quarles was a partner at the Carlyle Group, a private equity firm based here in Washington, D.C. Mr. Quarles has previously served in public service, having served as Undersecretary of the Treasury for Domestic Finance, Assistant Secretary of the Treasury for International Affairs, Policy Chair of the Committee on Foreign Investment in the United States, and the U.S. Executive Director of the International Monetary Fund. Mr. Quarles received an A.B. in Philosophy and Economics, summa cum laude, from Columbia and earned a law degree from the Yale Law School. Without objection, the witness's written statement will be made part of the record. The chair wishes to inform all members that I expect to excuse the witness no later than 2 p.m. this afternoon, and no intervening floor votes are expected at this time. Mr. Quarles, you are now recognized to give an oral presentation of your testimony. Again, welcome. But you do need to press the button for the microphone.
Thank you very much, Chairman Henseling, Ranking Member Waters, other members of the committee. It's a pleasure to appear before you today, and I appreciate the opportunity to testify on the Federal Reserve's regulation and supervision of financial institutions. The Federal Reserve, along with the other U.S. banking agencies, has made substantial progress in building stronger regulatory and supervisory programs since the global financial crisis, especially with respect to the largest and the most systemically important firms. These improvements have helped to build a more resilient financial system, one that's well positioned to provide American consumers, businesses, and communities access to the credit they need, even under challenging economic conditions. At the same time, we are mindful that just as there is a strong public interest in the safety and soundness of the financial system, there is a strong public interest in the efficiency of the financial system. Our financial sector is the critical mechanism for directing the flow of savings and investment in our economy in ways that support economic growth, and economic growth, in turn, is the fundamental precondition for the continuing improvement in the living standards of all of our citizens that has been one of the outstanding achievements of our country. As a result, the regulation of that system should support and promote the system's efficiency just as it promotes its safety. And moreover, our achievement of these objectives will be improved when we pursue them through processes that are as transparent as possible and through measures that are clear and simple rather than needlessly complex. In my testimony today, I'll review our regulatory and supervisory agenda to improve the effectiveness of the post-crisis framework through these principles of efficiency, transparency, and simplicity. I've also included an update on the condition of the industry and the Federal Reserve's engagement with foreign regulators in my written testimony. So to begin with efficiency measures. Last week, the Board and the Office of the Comptroller of the Currency issued a proposal that would recalibrate the enhanced supplementary leverage ratio, or the ESLR, applicable to our global systemically important banks, or GSIBs. The proposal would calibrate the ESLR so that it's less likely to act as a primary constraint, which can actually encourage excessive risk-taking while still continuing to serve as a meaningful backstop. Last year, the Board also adopted a rule that eliminated the so-called qualitative objection of the Federal Reserve CCAR exercise for mid-sized firms that pose less systemic risk. As a result, deficiencies in the capital planning processes of those firms will be addressed in the normal course of supervision, and I believe this approach should also be considered for a broader range of firms, and last week we called for comment on that potential expansion. On the subject of tailoring, I support congressional efforts regarding tailoring, as offered in both the House and Senate. In addition to this potential legislation, there are further measures I believe we can take to match the content of our regulation to the character and risk of the institutions being regulated. For example, I believe it's time to take concrete steps toward calibrating liquidity coverage ratio requirements differently for non-GSIBs than for GSIBs. I also think we can improve the efficiency of our requirements regarding living wills. The U.S. banking agencies have also taken a number of steps to advance more efficient and effective supervisory programs. For example, the agencies recently increased the threshold for requiring an appraisal on commercial real estate loans from $250,000 to $500,000, which doesn't pose a risk to safety and soundness. The Federal Reserve has also instituted various measures to clarify and streamline its overall approach to the supervision of community and regional banks in particular, which is detailed in my written testimony. Transparency is central to the Federal Reserve's mission in supervision, no less than in monetary policy. Late last year, in the first material proposal following my confirmation, the Board released for public comment an enhanced stress testing transparency package. The proposal would provide greater visibility into the supervisory models that often determine their binding capital constraints, and we're continuing to think about how we can make the stress testing process more transparent without undermining the strength and usefulness of the supervisory test. Looking ahead, we're also in the process of developing a revised framework for determining control under the Bank Holding Company Act. A more transparent framework should, among other things, facilitate the raising of capital by community banks, where control issues are generally more prevalent. Simplicity of regulation promotes public understanding and compliance by the industry with regulation. Just last week, the Federal Reserve issued a proposal that would effectively integrate the results of the supervisory stress test into our non-stress capital requirements. For the largest bank holding companies, that would reduce the loss absorbency requirements from 24 to 14. We estimate that the proposed changes would generally maintain, in some cases modestly increase, the minimum risk-based capital required for the GSIBs, although no bank would actually be required to raise capital because their existing capitals are well above those minimums, and generally modestly decrease the amount of risk-based capital required for most non-GSIBs. Our fellow regulators are also working with us to further tailor implementation of the Volcker Rule and to reduce burden, particularly for firms that do not have large trading operations and don't engage in the sorts of activities that may give rise to proprietary trading. In conclusion, the reforms we have adopted since the financial crisis represent a substantial strengthening of the Federal Reserve's regulatory framework, should help ensure that the U.S. financial system remains able to fulfill its vital role of supporting the economy. We'll do everything we can to fulfill the responsibility that has been entrusted to us by the Congress and by the American people. Thank you again for the opportunity to testify before you this morning. I'm looking forward to answering your questions.
Thank you, Chairman Quarles. The chair now yields himself 5 minutes for questions. As you heard in my opening statement, I'm very concerned with the policies and the implementation of the policies that are necessary to sustain long-term 3% plus economic growth. And I am somewhat fearful sometimes that one day I may wake up and find out that our financial firms have been turned into the equivalent of public utilities, which will not be commensurate with 3% economic growth. So I've raised this issue before, and that is the whole issue of supervision versus corporate governance. A number of institutions have come to this committee to say that representatives of the Fed have insisted on attending meetings of the board of directors or committee meetings of the board of directors. So my question is, do you believe that the Fed has the legal authority to demand attendance at board meetings? And if so, why is this a wise policy?
On the question of, I think the question of legal authority, I actually can get back to you on the answer of what our legal authority is. I think the more important question is it a wise policy? We ought to be focusing as supervisors on ensuring that boards are structured in order to be able to do their jobs, and that our supervisory and regulatory requirements of them support their fulfilling their roles in the corporate organization. We came out, as you know, with a board effectiveness guidance proposal last August when now Chairman Powell was then responsible for the supervisory and regulatory affairs of the board. And the purpose of that guidance was precisely to scale back some of the excessive micromanagement and sort of misdirection of board.
So that is its purpose. I must admit, I've heard from several who believe that it may have the opposite impact in bringing the board more into management, day-to-day management. So I'm heartened to hear that you think it will have the opposite effect. Let me run a couple of other situations by you. We've also, this committee has heard that some Fed examiners have made recommendations to management that certain board members, if you will, be fired. Again, does the Fed have the legal authority to make those recommendations? And if so, is that wise policy?
Again, on the legal authority, I'll get back to you with an analysis of what our legal authority is.
I would appreciate that.
I do think that at the highest level, it probably shouldn't be something that at the direct supervisory team level would be engaged. You know, at the highest level, if there were serious concerns about the fitness of a director, I think that probably is something that at the highest level of the Fed we should weigh in on. But those would be extremely rare cases, I think.
Something else we've heard that the Fed has weighed in on. We had representatives from one large diversified financial services company say their examiners questioned them about their lobbying activities. Now, the right to petition your government for the redress of grievances is enshrined in the Constitution. I assume you would agree that the Federal Reserve Act of 1913 does not trump the Constitution. Why would it be appropriate supervisory questioning to question one's lobbying activities?
I can't think of any reason.
Is that going to continue under your watch?
Now that I am aware of it, no.
Okay. Again, I guess as you know, typically corporate governance is determined by state laws. There's, frankly, hundreds of years of case law. I guess I am somewhat concerned, is the Fed trying to supplant itself over state corporate governance law? Where is the line to be drawn between supervision and corporate governance? Because it's getting rather murky.
So it certainly is our intention, actually, to demurkify that whole area, and that was the intention behind the board effectiveness guidance. We're receiving comments on that. We've received comments on that and are evaluating them. And I'll certainly be looking at those comments through the lens of ensuring that we are providing sort of a clear framework for, that allows bank directors and bank holding company directors.
Well, to borrow your phrase, there appears to be a lot of demercification to go. My time has expired. The chair now yields to the ranking member.
Thank you very much. Could you tell me why you have recused yourself on all matters related to Wells Fargo?
Thank you. Well, as you know, I do not have a legal conflict with respect to Wells Fargo. I completely cleared that legal conflict. In reflecting on some of the issues that were facing the board, I thought that it was appropriate to go beyond the mere requirements of the law and avoid even any appearance of an issue. As some of the members of the committee know, my wife's family had a historical connection with a bank that was acquired by Wells Fargo many years ago now. So even though it was not required by the law, and I do not have a conflict, I thought that it was appropriate for me to go above and beyond and avoid even a question.
Thank you. The Center for Investigative Reporting published several articles after a year-long investigation of 31 million records publicly available under the Home Mortgage Disclosure Act, that is HMDA. To identify lending disparities, using Philadelphia as a case study, the reporters wrote, I quote, "Lending patterns in Philadelphia today resemble redlining maps drawn across the country by government officials in the 1930s when lending discrimination was legal," quote unquote. The report noted that despite this evidence of discriminatory lending, 99% of banks were deemed satisfactory or outstanding based on inspections administered under the Community Reinvestment Act, a 40-year-old law designed to reverse rampant redlining. Would you agree that the CRA test is not vigorous enough if nearly all banks get good grades on their CRA exams, and yet discriminatory lending practices remain pervasive in 2018? Put another way, if 10 banks lend to one side of a city and no banks lend to the other side of the city, how can regulators change this dynamic and implement CRA to ensure banks, which are backed by all of that city's residents as taxpayers, fully serve the convenience and needs of the entire city's residents?
I think that reflecting on the current state of the Community Reinvestment Act and ways to improve its application, I think that's an important focus for the regulatory agencies currently. As you know, the Treasury Department recently put out a report for ways to improve and invigorate the application of CRA. I think that that is something that we should be strongly engaged in.
So do you support the Treasury's recommendations?
As I've reviewed them, yes, I think that there are, I think that it lays out a good framework for consideration. There are a lot of details that will remain to be, decided by the regulatory agencies, but I think that it's a good map.
Do you have any concerns at all about the satisfactory reports of these banks? 99%, I suppose, get satisfactory ratings, even though we have redlining. What do you think about that? What would you do about that?
Well, I think one of the issues that I at least have seen with respect to CRA is that over the years, it has become a little formulaic and ossified, and the ways in which both banks themselves and community development institutions themselves would like to, the activity that they would like to see happen really isn't the path of least resistance under practices that have developed under the CRA. So I think, kind of moving CRA off autopilot, which is one of the principal benefits, I think, of the Treasury review and of the efforts that are being undertaken by the banking regulators currently, is something that we should be doing, and that would help address some of the issues that you've raised.
So when you say you would move them off autopilot, have you determined that they simply get these satisfactory ratings without requirements that would make them a better and more effective? Or are you saying that they're just ignored, the requirements now? What are you saying?
No, I'm saying that, you know, the law provide, the banks have, the banks have developed ways of complying with the law out of genuine desire to comply. The examiners have developed expectations about what they know will be viewed by the community as passing. Community development institutions have developed, again, practices and expectations. And all of that could be really broadened to have greater effect as opposed to moving down the path of least resistance. It's not as though the law is being ignored. It's just we've gotten comfortable in how it can be applied, and we really ought to think about ways to apply it more effectively.
Thank you. I yield back.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Mr. Quarles, over the years, a large amount of agency guidance, handbooks, and circulars have been issued. Almost none of it has ever been withdrawn or rescinded. Almost none of it went through notice and comment rulemaking or was submitted to Congress pursuant to the Congressional Review Act. Should banks and examiners be treating this guidance as binding rules?
No. I do think that there is a role for guidance. I think that it's clear that in some instances, the practices of the banking regulators have blurred the role between guidance and rules. If something is to be a binding rule, both our obligation of democratic accountability as well as our desire to see that rule be as effective as possible and therefore receive as much comment as possible would require us to go through a transparent rulemaking process. That's good for both of those reasons. Guidance does have a role. The banks, in fact, want to know once a rule has been made if there are, where there are questions of interpretation. But we need to make sure that that guidance really is just guidance and doesn't supplant the rulemaking process.
Well, I appreciate that. I think, we hear consistently and frequently from banks that, these rules are sometimes being enforced as something more than just, guidance is being enforced as a rule versus whatever. And I know the other day we had Chairman Powell here, and he made the comment that guidance is guidance and rules are rules. So I look forward to some progress on this, so thank you for your comment. The DOJ has issued a memorandum prohibiting the department from issuing guidance documents that effectively bind the public without undergoing the notice and comment process. It goes on to prohibit DOJ from using guidance to require regulated parties to take any action beyond what is required by the terms of the applicable statute or lawful regulation. Would you support the Fed issuing a guidance policy along the lines of what DOJ just put out? We
are considering, we have communicated that message that guidance is guidance and rules are rules to our examiners and throughout the supervisory system. We're considering whether the right way to further formalize that. I think that's a salutary process, yes.
I've got a couple more questions here, but I want to make sure I get to this one with regards to cost-benefit analysis. While the executive branch agencies are subject to mandatory cost-benefit analysis requirements, independent agencies such as the Federal Reserve are not. There is no statute that generally imposes on the Fed a requirement to perform regulatory impact analysis or cost-benefit analysis. However, during a January 19th speech at the American Bar Association Banking Law Committee annual meeting, which is a mouthful, Vice Chairman, you indicated additional efforts to implement cost-benefit analysis, and I won't go into your comment, but because it's quite lengthy, but it also is very instructive. Furthermore, it has been reported that the Federal Reserve has created a new department named the Policy Effectiveness and Assessment Committee, charged with conducting cost-benefit analysis on regulations. Number one, would you like to elaborate on these comments? And number two, can you explain the creation of this new department and is it being used?
So I think as you've indicated, the thrust of my comments, and as I indicated in my opening remarks of the testimony, we have a very strong public interest in ensuring that our financial system and our regulation of the financial system are efficient as well as that they're promoting safety and soundness. And that necessarily involves an assessment of the costs versus the benefits of regulation. Both the sort of direct costs of compliance that are imposed on institutions, as well as the larger question of the effectiveness of the regulation in achieving an objective versus the broader costs that are created by that regulation. We are looking at that at the Fed. We have stood up a group of economists that are examining the body of post-crisis regulation through those lenses to determine exactly, how we measure the effectiveness of sort of the key areas of capital and liquidity and resolution effectiveness. And I'll be looking, that is a kind of a complicated and lengthy process, and I'm looking forward to the results of their work.
Well, as you know, that with Dodd-Frank, we have a lot of community banks and credit unions going out of business because of the cost of compliance. And yes. I would hope, this is a really important question I've just asked you with regards to cost-benefit analysis. While a rule may be well-intentioned, if it's going to drive businesses out of business, so there's a limited access to credit or raises cost for that credit, our ability to do financial services work, it really harms the consumer, and we have to really think about that. Thank you very much.
Time of the gentleman has expired. Chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of the Capital Markets Subcommittee.
Thank you, Mr. Chairman. Governor Quarles, as you know, the Senate's banking bill, sponsored by Senator Crapo, includes a provision that would allow custody banks to exclude reserves that they hold at the central bank from the supplemental leverage ratio, or SLR. And then just last week, the Fed and the OCC proposed an amendment to the SLR that is intended to address the same custody bank issue that Section 402 does. So in your view, do the Fed's proposed changes to the SLR make Section 402 of the Crapo bill unnecessary?
No, I wouldn't say that they make that unnecessary. Our objective, both our objective and the objective of that provision, as you know, are to adjust the ESLR so that it is not a primary binding measure. Because when you have a leverage ratio that is creating the incentives for decisions at the margin, because that leverage ratio isn't risk sensitive, that means that your decisions at the margin will not be risk sensitive. You'll have an incentive to basically take on more risk. So I think it is important to calibrate that down. There are two ways to do it. The Crapo bill has proposed one way. Our regulatory proposal would accomplish it.
So you see them coexisting? You see them coexisting?
Yes, if the Senate bill were to become law, if that provision in the Senate bill were to become law, I think we would have to, we would then have to consider how to calibrate our proposal to take account of the fact that certain banks would have had the denominator of the ESLR changed for them. That would be appropriate if that does become law.
And as you know, the Fed proposed a package of changes designed to increase the transparency of the Fed's stress test last December. Personally, I believe that the Fed's proposals is more than adequate to address transparency issues. You've stated that you believe that these disclosures should, quote, go further, and that the proposed changes don't go far enough to provide visibility into the stress test models. So my question is, what additional disclosures do you think should be made about the stress test models?
We've received a lot of comment, as you might expect, on that proposal, and we're in the process of carefully examining those comments. So I don't want to, at this point say exactly where we'd land. I think it's clear from the thrust and the strength of the arguments in those comments that there are areas where we will be able to provide more transparency without undermining the effectiveness.
But which areas? Do you know which areas? Mm-hmm.
I think one example that we do want to consider, and where we had called for comment, is with respect to the scenario design itself, as opposed to simply the models that are used in the stress test. I think that we would actually benefit, and the credibility of the scenarios would benefit from some period, not not an excessively long period, but for some appropriate period of input from the public on those scenarios each year.
Okay, thank you. I want to ask you about the Financial Stability Board, or FSB, which is an international body of all the major financial regulators, including the Fed, to monitor, where they monitor the global financial stability. Do you believe it's in the country's interest to participate in the FSB?
I actually do, yes. I think it's actually, we have a strong national interest with respect to...
What about, if my time's almost up, what about is it important for the U.S. banking regulators to participate in the Basel Committee on Banking Supervision?
Yes, to ensure a level playing field for our banks, we need to be able to influence those decisions and not...
and so, do you believe that it would harm the American banking system if they pulled out of Basel and the FSB?
I think that the processes of those institutions can be improved. I think that we can improve their transparency. Even they have acknowledged that. But I do think that we should remain engaged in them, yes.
Okay, thank you. My time has expired.
The lady yields back. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of our Capital Markets Subcommittee.
Thank you, Mr. Chairman. And I want to, Mr. Quarles, I want to revisit the issue that you had talked about with the chairman in his questioning, and that you twice said that you would need to, quote, get back to you on the legalities of the Fed involvement at the board level. It seems to me that this is a crucial question to what the boundaries of intrusion to the day-to-day management of a company that the Fed has as a regulator. Somewhat to that point, I would like to, Mr. Chairman, submit for the record a joint letter that myself and Chairman Barr and Chairman Duffy have sent you. I haven't expected that since it was dated Friday. You probably haven't seen it as of yet unless you were in the office on the weekend. So, without
objection.
And what it is specifically the supervisory expectations for board directors. It was docket number OP 1570 on guidance. We write with you some concern that the potential to further empower the Federal Reserve to manage to address the regulatory overreach in the boardroom has placed undue burdens on bank boards. I don't want to read the whole letter here, but although the proposed guidance purports to distinguish between the role of the board, one of oversight and guidance, and the role of management, day-to-day functions, it continues to inappropriately blur these lines by creating numerous new requirements that a board, quote, ensure, establish, approve, set, develop, or detail. All of those were in close quotes. Items that simply do not reflect the board's oversight of and guidance to management. As such, these terms would impose new legal and managerial requirements on a board that would have the board direct a bank holding company's daily business decisions. I think this really gets to what both the chairman and a number of us have said is if you have a financial institution that is not in trouble, that hasn't tripped any of these legal wires, really what's the legal standing for the Federal Reserve and its regulators to come in and be involved with board decisions, much less discussions within committees of that? So again, as I said, we must establish those legal boundaries of intrusion by the Fed. So I look forward to your response to this letter. I do want to.
And I actually have seen the letter.
Well, I commend you for that. So glad to hear that. I do also want to move on real quickly to Volcker, and on page 10 of your testimony, you address it briefly, and I think you acknowledge what many of us are concerned about is that it is very complex and it has not been working well. And as you say, while the fundamental premise of the rule is simple, the implementing regulation is exceedingly complex. You talk about the fellow regulators working to further tailor implementation of that. Could you tell us exactly who you're working with as those fellow regulators and what they're doing?
Yeah, there's engagement from the top of the 5 Volcker agencies down. That's the CFTC, the SEC, the FDIC, the OCC, and the Fed.
All an alphabet soup of regulators, I might add.
Yes,
we have
it's
5 regulators that are in charge of this.
Yes, it is. It is a five-headed hydra, and there are certain collective action issues with that. But I would say that over the last few months, we have been working together. The other regulators have been working with the Federal Reserve to develop a revised Volcker Rule proposal.
Is the Volcker Rule, as it's written, detrimental to capital markets right now?
I think that's unarguable. The extent of the effect on liquidity is something that economists do argue about, but that there is a consequence, and simply that there is an excessive burden as a result of the Volcker Rule, a great deal of uncertainty, a great deal of cost. I think that part is unarguable.
And does the board or any other regulators tasked with implementation, those 5 others, can you repeal the Volcker Rule, given the Volcker Rule is technically under the Bank Holding Company Act?
We can't repeal the Volcker Rule, and there are certain limits on our ability to make changes that we might otherwise have thought appropriate, because of the terms of the statute itself. But there is a lot that we can do to increase the certainty of application, to reduce the burden of application, and the other agencies are working with us really quite well together in order to effect that.
We will be watching closely. My time has expired. I appreciate it. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Mr. Quarles, news reports indicate that the Fed and the FDIC have been participating in discussions with the OCC over potential changes to the CR. But it remains unclear whether the Fed and the FDIC will sign on to the OCC's advance notice of proposed rulemaking. What can you tell us about these discussions? Do you agree with the direction the OCC is taking?
So those discussions, they've had the full engagement of all 3 of the banking regulators. And so far they have been, and I have no reason to expect that that would change, they've been collaborative among all 3 of us.
Do you anticipate the Fed signing on to the OCC's ANPR?
So I think that there will be a joint ANPR that comes out. Right now, I do expect that to be a joint proposal.
Well, Mr. Quarles, I just would like to say that the CR is extremely important for LMI communities. While I agree that there is a need to look at the CRA, I would be very concerned with any proposal that drives investment away from these communities. Mr. Quarles, I have a question about Wells Fargo submitted plans. But I hear you, you said that you have recused yourself from any matters as it relates to Wells Fargo. But my message to you and to Wells Fargo is that we are watching Wells Fargo, and we want to make sure that the concerns or the consumer abuses that Wells Fargo engage in are put to an end.
Thank you, ma'am.
Regarding the asset cap, I echo the statement of the ranking member with regard to Wells Fargo asset cap, and I will be concerned if it is removed too soon. Chairman Quarles, last week the Fed proposed loosening the supplementary leverage ratio for the 8 largest U.S. banks. While the OCC joined the Fed in the proposal, the FDIC did not. And FDIC Chairman Martin Grunberg specifically cited the reductions in the capital requirements as the reason the FDIC did not join the Fed and the OCC. And he went on to say that strengthening the leverage capital requirements for the largest, most systematically important banks was among the most important post-crisis reform. What do you think of the FDIC's decision not to join the proposal, and how would you respond to Chairman Grunberg's statements?
So I agree that the emphasis on leverage capital ratios after the crisis has been important. And frankly, that was something that I learned from the crisis. I have a higher estimation of the role of leverage capital ratios in the overall capital regime, given the consequence of the crisis, than I did before. I do think, however, that their role is as a backstop, and that the most effective and efficient capital ratios are those that are risk sensitive. If we allow any of the various leverage ratios that we have, but if we allow a leverage capital measure to be the marginally effective capital measure for an institution that drives its decisions at the margin, then we are creating a regulatory incentive for that institution to add risk rather than to reduce risk, and we probably shouldn't do that. And so in evaluating the changes that we proposed to the ESLR last week, I looked at what was a relatively modest capital reduction under that leverage ratio. It was a few $100 million out of the many, many, many billions of dollars of capital in the system, against the benefit of changing that incentive, and I thought that this was the right time to do it.
Wouldn't that be a slippery slope? You're going to start with, a low reduction and then go on to reduce it more? Let me just say this. We took substantial steps to raise capital to ensure that the largest banks do not threaten the financial system. And I will tend to agree with Chairman Grunberg that any proposal to lower the capital requirements is a bad idea. I yield back.
Gentlelady's time has expired. With that, the chair recognizes gentleman from Wisconsin, Mr. Duffy, the chairman of the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and Mr. Quarles, welcome. It is, as my colleagues have mentioned, nice to have you here and testifying before the committee. As we've complained, it's been long overdue, so welcome. I first want to thank you for your ongoing work to reevaluate the systemic risk or lack thereof of our U.S. insurance industry. Thank you for that. Now, we all know that you have direct oversight over our savings and loan holding companies and those that have been designated as SIFIs by FSOC. But you have a more indirect role through international insurance standard setting with the Fed's seat on the FSB and the IAIS. The IAIS is developing international capital standards similar to our European solvency standards. So maybe first for you, do you believe that our state-based insurance regulatory model has been effective in the U.S.?
Yes, I think that over the long life of insurance regulation that has been
100+ years, it's been pretty effective, right?
Yeah.
Okay. And so will you commit that the Federal Reserve, in your work with Treasury, will make clear that we will not cede our regulatory system and move forward with the development of a European-centric international capital standard unless IAIS leadership acknowledges the U.S. insurance regulatory system has as satisfying any IAIS created standards, making sure that we're preserving our U.S. model, not ceding our U.S. model to a now European-centric model?
Yeah, we, in those discussions, the Federal Reserve has been a voice for the so-called building block approach to capital regulation that is, that has been supported through the U.S. processes, and we will certainly continue to do that. So,
but in regard to trying to preserve our state-based model here, what's your view as you negotiate with the IAIS?
Well, we certainly, we both wouldn't and couldn't, just given the nature of those bodies, do anything that would kind of affect the federal distribution of, by federal with a small f, yes, distribution of insurance regulation in this country.
Some of us might disagree with what you actually can do through international negotiations and agreements, but let's leave that aside, and hopefully we can work together further on this issue. Want to move, and you've had this issue brought up a couple times by the chairman and by Mr. Huizenga, in regard to board management and the Federal Reserve pressuring the boards to fire certain members. Are you aware of that actually happening? Because we've had a number of people coming in and giving us feedback that that's taking place.
No, I am not aware of that happening, but I'm not challenging that it's happened either. I think that that's disturbing.
Okay, and if you're hearing this, as you sit here today, maybe for the first time, are you concerned that that would take place?
Yeah, I would think that that's the sort of supervisory engagement, as I indicated with the chairman. I don't know that it's I don't think that it's always inappropriate that the Fed might have a view on that.
Who elects the board? I mean, give me 101 here.
The shareholders, obviously.
The shareholders do. So does the Fed have a role in electing a board?
If there were a profoundly
So the answer is yes, that the Fed does have a role in electing board members?
Well, not in electing the board members, but
firing board members that the shareholders actually elected. Is that your position?
In very rare circumstances, I think that could be appropriate if there is a completely unsatisfactory board member. But it
as determined by the Fed, not by the shareholders.
If determined by the Fed, yes, I do think that that could be appropriate in some circumstances.
So in essence, we can say the Fed really can step in at any point and say we don't like board members. We can supersede shareholders and we can put pressure to have them fired. Is what you're saying today?
Oh, the law, for example, would not allow the shareholders to elect people who are committed to certain crimes from being board directors. And if they did, it would be appropriate for the Federal Reserve to say that's not an appropriate director. I think I'm really on your side on this. I think that should be something that's extremely
I think this is a space
rare.
that I think you need to take a look at. It's concerning, the Fed's role here. And I think if you take some time, we're going to be on the same page on this issue.
Exactly.
Want to look to examiners in their exams asking questions of financial institutions about their lobbying efforts. Would that concern you? Is that a proper role of the Fed to ask questions about how a financial institution is lobbying the Congress?
I can't imagine how it would be.
Okay, and are you going to implement policies or procedures to root this problem out?
Yeah, absolutely.
And does that come by memo, directive, email? I mean, I think you have to think about how do I actually stop this practice, get it down to the boots on the ground, and make sure this practice actually stops. And my tap is tapping, and I yield back.
Gentleman's time has expired. With that, the chair recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
How are you, Vice Chairman Quarles? Good to have you in the committee. Mr. Quarles, in your testimony, you said this. You said that you personally believe that our stress testing disclosures can go further. And you said that we should consider additional measures such as publishing our stress testing scenarios out for public comment. Well, and with all due respect, I couldn't disagree with you more. Let me explain why. I was the Democratic lead and negotiator on the stress testing bill that we marked up in committee last week, as you know. We passed that out. And when I negotiated with my Republican partner, Mr. Zeldin, I negotiated out that language that would have required the Fed to publish their stress test scenario. And let me tell you why. I think the Fed must be very, very careful not to expose how they're going to conduct these stress tests. Because, as you well know, stress tests are meant to evaluate what happens or what may happen to a bank's assets under stress. But if a bank knows and is aware in advance of how you're going to do the stress testing, then that bank will be able to optimize its balance sheet for that particular day on which you're doing the stress test. So I hope you will consider that. We passed the bill. It's in there. But all due respect to you, I think your point's well taken, but I hope you understand that you can't let the cat out of the bag before it's time to get the fair adjustment. Now, on another point, on fintech, there are many people who think that fintech businesses are just in California and New York. But in Georgia, in Atlanta especially, we're becoming the burgeoning capital of this new and exciting industry. And so you also mentioned in your testimony when we talked about that the innovations in this industry can expand access to credit, you said, including to underserved communities and small businesses, which can really benefit the economy. I agree with you 100%, but I also believe that fintechs can be the answer to so many other serious problems. But here's where we are. The GAO did a report, as you know, and we talked about that. And there's a problem. There's a lack of coordination, a lack of harmonization. Now, I'm working on legislation that will give the fintechs a voice because they need to have a point of entry into this new regulatory stream. Secondly, they need to have harmonization. It's not just you in the Fed that's seeking to regulate this fintech. You got the OCC, you got the CFPB, you got the CFTC, you got all of them clamoring here. So I wanted you to know about our legislation. I'd like to work with you that because of all of the regulators, it is the Fed that is the anchor of our financial system. You're the point person for that in this very good and new position that we created as the supervisor for regulation for the Fed. And finally, I want to just ask you if you could help us with something. My good friend, Mr. Lukemeyer, got a bill, the SIFI bill. It passed, too. Much of what means something is coordinated into Senate Bill 2155, but it's sitting in the House. People say it's going to die. Can you help us? Can you get on the phone over there and help us move this bill and get it going?
Well, I'm very supportive of the efforts in both the House and the Congress to kind of further increase the legislative framework for tailoring the application of our regulation and supervisory principles to institutions, and particularly to relieve the burden on smaller institutions. I'm very supportive of that.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner, chairman of the Oversight and Investigation Subcommittee.
I thank you, Chairman Hensarling. Vice Chairman Quarles, welcome at long last. Since I have a couple of topics that I wanted to touch on today, I'll get right to the point. In your testimony this morning, you noted that the Federal Reserve is very focused on the increased risk to all financial institutions and are working to strengthen the cyber resiliency of the financial sector. Further, you have stated previously that cyber attacks are often connected to poor basic information technology hygiene, and firms must continue to devote resources to these basics. We also know that attackers always work to be one step ahead, and we need to prepare for cyber events. Those are your words. Recognizing that cyber attacks have increased dramatically over the last decade, do you think it is more important that cybersecurity staff at financial institutions are better using their time to protect their company and other critical infrastructure, or to help answer regulatory exam questions from a multitude of different regulators?
I think you put your finger on something that's very important. I do think, and you know, across the government, there's an effort to sort of approach this in a systematic and effective way. You know, I do think that our supervisory engagement on the cyber issue can be improved to be better directed at actually supporting the ability of these firms to be resilient to a cyber attack. There is, there is a fair bit of kind of pure compliance as opposed to real focus on the cyber risk, in our current engagement, and we need to work to improve that, and we are.
I think so. We need to make sure that the companies are actually protecting themselves, thus the consumer, as opposed to dealing with the constant flow of regulatory exams and things of this nature, doing the real work that keeps us safe, keeps our information, our data, our privacy safe when it comes to cyber attacks.
Completely agree.
Thank you. You talked also about continuing to collaborate with other federal agencies on this topic. Are there any specific examples of collaboration where the Federal Reserve is aligning its supervisory activity with other financial services regulatory agencies as it relates to cybersecurity?
So there are existing interagency processes of the government that we participate in, and there are also and through the FSOC these issues are also being considered. So there's a fair bit of interagency engagement in trying to determine exactly what the right way to improve our focus on actual resilience as opposed to pure compliance, if you will, can be done. We're still in the process of doing that. It's a difficult question, but an extremely important one.
You say then you are collaborating with the FSOC.
Yes, yeah, with the FSOC and the FBIC, the FBIIC, I think is the acronym.
Okay, great, thank you. Switching topics somewhat, I want to go back to something you said in your testimony about innovation. You talked about making sure that regulations don't stifle innovation. But as regulators, it is your job to make sure it is done in a responsible way. What are you doing to ensure banks understand and manage these risks?
So that's part of our sort of regular supervisory engagement with the firm. We, as part of that, we also look at the connections of a banking institution to both their technology exposure as well as their technology engagement, and a lot of that is individual to each type of institution, and the direct supervisory teams have individual assessments of each firm.
Concerned that by putting a large focus on systemic risk, are we discouraging innovation? Are we putting competition for consumers at risk?
Well, it's our job to ensure that we don't. I think that that's something that we need to keep in mind. And one of the themes that I've tried to stress in general about our regulation and supervision currently is that, I think in the decade following the crisis, the focus was entirely on systemic risk and safety and soundness, and all those are important. But we also need to focus equally on efficiency and innovation and supporting that.
Completely agree. My time's lapsed. I thank the chairman for his indulgence, and I thank and welcome you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Thank you very much for being here today. FinTech is rapidly becoming a financial behemoth. And I'd like to get your reaction to, first, this phenomenal and continuing growth, and then secondarily, what, if any, involvement in or monitoring of FinTech will the Fed look at?
So, there clearly is a lot of innovation that's going on in the fintech space currently, has been for some years, and the opportunities that creates for improvement of consumer service, I think that they're real, and we're seeing that happen. Most of what people think of as fintech, the the startup firms in various parts of the country that are creating different types of user interface to the financial system do plug into the traditional financial sector at one point or another. They have behind them a traditional bank that is providing the funding or providing the actual payments, payment system services that the fintech firms are the interface for. And in the supervision of the traditional banks, we both have insight into what's happening in the fintech sector. We can look into their activities through our ability to examine them under the Bank Service Act, for example, if they're, when the connection is such that allows that kind of examination. And so so I think that we do have tools currently that allow us to look at that sector and understand what's happening there.
But nothing alarms you?
I wouldn't say there's anything alarming currently. I think that there are issues that are raised, and we, and we think about them and are addressing them.
Do you believe that there is some way that fintech can help resolve the payday loan issue that impacts millions of low-income Americans?
Well, one of the hallmarks of fintech generally is reducing cost, and particularly for and particularly for retail transactions. It's not really my role as a supervisor to make suggestions as to how that issue ought to be addressed through a particular commercial means. But
we don't care. I mean, we don't. You can do it. Go ahead.
But I can. But I can certainly imagine that happening. It would certainly be something that would be beneficial.
Well, I'm just curious because of they really are not being regulated right now, and so it would seem to me they have enormous flexibility that could be used for something that that most people believe to be important. I don't have much time left, so I apologize, but I wanted to get into to that even more with you. But let me move to the one of the other issues that I'm concerned about, and it is unemployment among African Americans and Latinos in the country. Through the Obama administration and then the Trump administration continuing, the unemployment in the country has blessedly dropped significantly, and all of us should be happy about it. However, the minority communities are still not dropping at the same rate as non-minorities. Is there anything that can be done since in your portfolio there is this issue of employment? Do you have anything in the toolbox that you think would be of help in trying to reduce minority unemployment?
So in the Fed's toolbox, our mandate, which we pursue assiduously, is maximum employment, maximum aggregate employment. And obviously that has an effect because as maximum aggregate employment has been increasing, unemployment decreasing, unemployment for all segments of the population, including minority segments, has been going down. That differential remains. We don't really have the tools to address it, but we do try to provide information and analysis of it to help others who do have the tools.
Time of the gentleman has expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chairman of our Monetary Policy and Trade Subcommittee.
Congratulations, Mr. Vice Chairman, on your confirmation, and thank you for your testimony today, recognizing that regulation should support and promote financial system efficiency just as much as regulation should support safety and soundness, because I think, as you would agree, overregulation and cost burdening our banking system can just as much weaken our financial system and contribute to illiquidity as inadequate supervision could. As you know, the Federal Reserve's performance as a bank regulator in the lead-up to the financial crisis has been subject to scrutiny and criticism on both sides of the aisle and across the political spectrum. Despite having teams of resident examiners embedded in the largest financial institutions in the run-up to the financial crisis, the Fed failed to identify material weaknesses in these firms' operations and failed to identify risks that were lurking in those portfolios until it was too late. Yet instead of scaling back the Federal Reserve's authority, the drafters of the Dodd-Frank Act chose to double down, and they conferred broad new power on the Fed to regulate virtually every corner of the financial sector. And it can be argued that the Dodd-Frank Act made the Federal Reserve our nation's most powerful bureaucracy. So given the Fed's enormous new supervisory and regulatory powers now, an argument can be made that the Fed should be made more, not less, accountable to Congress. My question to you is in reference to my colleague Congressman Davidson's proposal, the Federal Reserve Regulatory Oversight Act, which would bring the non-monetary policy-related functions of the Board of Governors into the appropriations process. What is your take on that proposal?
So I've thought a lot about these issues and wrestled with them because the importance of the democratic accountability of the Federal Reserve is something that you know that I share, and it's important to our ability to do our jobs. Similarly, and I know it's something that everyone in this committee shares as well, I think that a democracy can appropriately determine and wisely determine to create a buffer of independence around certain functions of the country, some of the law enforcement functions, some of the monetary policy functions. So the question is, does a proposal to bring the non-monetary policy functions of the Federal Reserve, how does it balance those two objectives, democratic accountability and independence around the monetary policy function? I am concerned that it would, because of the fungibility of money, create the possibility for some future Congress to put pressure on the monetary policy side.
Well, I'd like to work with you on that. My time is running out, so I want to move on. But I want to work with you on that because I think there are I respect the Fed's independence as chairman of the subcommittee oversight over monetary policy. I respect Fed independence with respect to monetary policy, but with respect to your jurisdiction and supervision and regulation, the Fed arguably is the most significant, powerful regulator in America with respect to financial services, and I think it's altogether appropriate, no matter what your perspective, whether there's too little or too great regulation, there should be accountability. And I want to work with you on that and Mr. Davidson to make the Fed more accountable with respect to regulation. And to that end, the Fed's decision to reduce the burden of stress tests on non-complex firms by focusing the qualitative review in CCAR to the largest, most complex financial institutions, I believe is a good first step. And I compliment the Fed on that. However, with regard to the Fed's newly proposed stress capital buffer, do you agree also with your predecessor, who was not known as a deregulator, Mr. Tarullo, Governor Tarullo, that the qualitative assessment in CCAR be phased out for all banking organizations, especially in light of the recent stress capital buffer rule?
Yeah, I think that's something that we should consider and have called for comment on. Definitely.
Well, I appreciate you considering that. And with respect to that proposal to create a stress capital buffer, as you know, the main driver of these stress tests is the severely adverse scenario, and it has been published by the Fed without the benefit of any public comment or external review. And the model that will be employed to calculate the bank's stress losses using that severely adverse scenario is the Fed's proprietary model. But is there no transparency regarding the elements used in determining a significantly and potentially highly variable component of the minimum capital requirement, and is the Fed open publishing these scenarios and models for notice and comment?
I think that we need to get more public input on them. A full APA notice and comment process, which could take years, I think that might be logistically difficult, but I think that there are ways that we can get genuine, serious input and still be consistent with the purposes of the test. I agree with you.
Thank you. My time has expired.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee.
Thank you so much, Mr. Chairman, and welcome to you here today, Mr. Vice Chair Randy Quarles. I welcome you to your new position, and I hope that you're prosperous. I guess I would just like to hear, since you are new, what lessons that you learned from the financial crisis that you can share with us.
So I would say that there are some specific ones, there are some general ones. Probably the most general one is a sense of humility about the omniscience of the regulators. As has been mentioned and is certainly widely known, the regulators were closely involved with the financial system at a very granular level, and for a period there, at least on a policy level, when I was at the Treasury Department, I certainly was involved with policy regarding the financial sector. And while we considered issues about potential financial stress, none of us believed, none of us knew that that this sort of financial stress was coming. And indeed, most people didn't. So I approach my current responsibilities with a great sense of humility about the ability of even very well-meaning, smart, engaged, informed people to know the future, and I think that has to inform how we think about what we think are good ideas currently. There are some specific examples as well. I mentioned one of them, the leverage ratio. I did not have a sufficient regard for the role of leverage capital requirements in the overall capital
before
system.
the crisis or since Dodd-Frank?
Before the crisis, and
okay.
And since then.
So Dodd-Frank has helped in that regard.
Well, I would say that the regulatory response in general has been appropriate following the crisis.
All right. So banks are doing really well right now. Their profits are up, their shares are up. But we see a constant sort of drumbeat of complaints, I think, from some of the larger banks and maybe even some of the regional banks regarding so many regulations. So very specifically, I'd like to know, do you support the Volcker Rule? Do you support what Dodd-Frank has done with the new derivative framework provided to FSOC as examples? Of two things. Do you support those things?
So the Volcker Rule, as it has been implemented, I do think isn't working well. I think that it's excessively burdensome. I think it creates uncertainty, and so I think it's not really an effective implementation of the statutory requirements.
So you're not afraid of sort of proprietary trading at all and sort of ratcheting things up to where we were?
Well, as a regulator, we can't change the Volcker Rule, so that will remain the law of the land. I think that we can implement the statutory intent in a way that is actually more effective by clarifying, simplifying the rule, and reducing the burden of complying with it.
Okay. Let me briefly share with you. The Fed Chair, Powell, has recently been with us, and he's talked about the profitability of the banks and their returns on capital and buying back stock and so on. And so I'm wondering if you're concerned about any negative or adverse impacts that you see with the banks enriching themselves and buying back stock, harm to our economy overall. Is there any concern on your part?
So I think that a healthy financial sector is in our interest. It's one of the, having a robust financial sector ensures that we've got robust support for the real economy and for economic growth in the real economy. As long as that sector is healthy and is safe and sound, our job as regulators is to ensure that they are operating in a safe and sound manner. And then the distribution of their profits is up to the shareholders and management, and some of that will go to customers, and some will go to employees, and some will go to shareholders.
Time of the gentlelady has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you very much, Mr. Chairman. And Vice Chairman Quarles, thank you. I think in your analysis, in the response that you gave in terms of the regulatory community and what you did not see coming, it's partially true, but there was one thing the regulatory community did see coming and tried to do something about. It was the over-leverage of the GSEs, Fannie Mae and Freddie Mac, which reached 100 to 1. And in 2003 and 2004, I had legislation that tried to control for systemic risk, tried to transfer the authority to the regulatory community to take down that over-leverage in terms of those portfolios. And the regulatory community, the Fed in particular, was very supportive of that. We could not get that legislation through. I would say that they saw that coming. What perhaps they didn't see coming was also the investment banks, the 4 big investment banks, in doing their own modeling, had leveraged up their ratio from what should have been 10 to 1 to probably 30 to 1. And so the combination, first housing collapsing with the GSEs, and then on top of it, the big investment banks, I think that was a major blow here. I think what we're rediscovering in this generation is that this cyclical nature of the economy, because we fail to maybe adjust or regulate for these kinds of problems, are with us. And I think, unfortunately, maybe Washington tends to exacerbate in some ways, maybe exacerbating, rather than mitigating the booms and the busts. And I just wanted to ask you about that, because Washington is willing to come in and scale back capital requirements, right, when times are good. When times are bad, as we saw during the last crisis, Washington overshoots and limits the ability of banks to aid in the economic recovery. And we all saw countless examples of that with community banks. Mm-hmm. What is your view on regulation in terms of the economic cycle? Where do you think we are in the cycle, and how does that impact your assessment of regulatory changes, especially now as it relates to capital?
So those are extremely good questions. In general, banks should, and I think that they are, build their capital during the good times so that they can survive stress when it comes. And we know that there will be periods of stress in the future. I think that it's an open question. There are regulatory tools that are designed to try to provide those counter-cyclical incentives. The stress test is one of them. It becomes, as asset values increase, as times become good, the stress necessarily, if you assume that asset values are going to fall to a certain level, that stress is going to be greater, and that provides a certain counter-cyclical incentive. There are other tools that we could use. At the same time, the efficiency of the system does, is supported by predictability. The ability of the CFOs and the banks to predict how their bank ought to respond to the overall regulatory system, and balancing that is the difficulty that we wrestle with.
Let me ask you another question. Is it possible for businesses around the world to take advantage, you said, of the fact that we're in a world of opportunity, but it's an opportunity that's unbalanced? The developed world will face strong, significant headwinds for quite an amount of time. The emerging world has both robust growth and growth that's being driven by consumer consumption. So that was your point. Shouldn't we be looking outward to the emerging world for growth? We've got 5% of the population, 25% of the GDP. Shouldn't we support a renewed interest in the Trans-Pacific Partnership as a net positive for the U.S. economy in terms of that engagement? Just your view on that.
Well, the Fed's responsibility, I think that the Fed's responsibility is not trade partnerships, but in general, certainly the United States has benefited from an open trading system and from open trade, and that has been in our interest over a long period of time.
Thank you, Vice Chairman Quarles, very much. And Mr. Chairman, I thank you as well for this hearing.
The time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Good morning, Mr. Quarles. How are you?
Thank you.
So the Center for Investigative Reporting looked at 31 million mortgages using HMDA data, and they found evidence that redlining is still alive in about 61 major American cities. Did you see that report?
I have not had a chance to study it, no.
We'll send it to you. I think this is absolutely unacceptable. 50 years since the passage of the Fair Housing Act, which banned discrimination in lending. 41 years since the passage of the Community Reinvestment Act, which requires banks to lend and to invest in communities which they operate, including low and moderate income communities. In a recent speech, you said that you want to improve, and I'll quote you, the current supervisory and regulatory framework for the CRA to further the statute's objective of promoting access to credit and financial inclusion. What did you mean by that?
Well, I think that the objective of the CRA is a broad one, which is to...
I'll reclaim my time. I was hoping you had some things in mind. Do you have specific things you want to do with the CRA that you could identify today?
Well, we're working with the other regulators on specific proposals, and since those aren't out yet, I don't want to...
You don't want to mention them just
process.
Yet? Well, yeah, so it's in the process. So, look, can you assure the members of this committee today that you will not support any changes to the CRA that will result or cut lending in low and moderate income communities?
The objective of the changes we're considering is to improve support to communities, not to cut it.
Right, so that's the objective, but the outcome is what I'm asking you about. Can you assure us today that you will not support changes to the CRA that will cut lending in low and moderate income communities?
That certainly wouldn't be my intention.
Okay, so what assurance can you give us that your intentions will be fulfilled regarding the CRA?
Well, I'll be here again shortly, and you can hold me accountable for the outcome of our proposals. We will seek comment and on the proposals that we make, and take seriously people's comments as to whether we're achieving our objectives.
Okay. Well, early this month, the Treasury released a series of recommendations for revising the CRA, which you've alluded to already. One of those recommendations relates to penalties lenders face for failing CRA exams. Only about, I don't know, 1 or 1.5% fail, right?
It's rare to fail.
Yeah, it's rare to fail. But the report says a bank with a less than satisfactory CRA reading, about 1% of the people or banks, should continue to receive enhanced scrutiny, but more consideration should be given to the bank's remediation efforts to date and whether improving the application would benefit the communities served by the bank. Do you believe Treasury's plan to relax penalties for banks who fail the CRA exam will achieve the CRA's intention and your intention of increasing lending and investment in low-income communities?
Well, I don't think that Treasury's intention there in that reference is to relax penalties, but rather to consider the overall consequences of a particular transaction that may be proposed. There are certainly circumstances where the low and moderate income portions of a community can be actually helped by a particular transaction that under current practices might not be allowed for...
You mean like payday lending and rent-to-own? Is that what you have in mind?
No, simply the increasing the ability of a particular institution to serve a low and moderate income community might be helped. I think they're saying we ought to look at the facts and circumstances of the case, and that I would support, and try to decide whether we're actually achieving our objective.
Well, when you think about 61 major American cities, having evidence of redlining based on home mortgage disclosure data, and still 98% pass. I think that the exam should be tougher, not easier. And I hope that you will carry that forward, because for the people who are denied mortgages after they've qualified based on sometimes the color of their skin, I hope you share my concern with that and will use your authority to uphold people's rights.
I definitely share the concern that there should not be discrimination in lending.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Chairman, and Chairman, thank you for being here as well. You know, I am one of those people that firmly believe that access to capital and liquidity are probably the lifeblood of a stable and vibrant flow of commerce. And you know, I've seen the accumulation of capital, but yet I have not seen until recently the investment of capital. And what concerns me about that is that while those that form capital for investment purposes to strengthen an economy do so and choose to do so in environments that are more conducive to investment and consumer satisfaction, just has not been what Dodd-Frank resulted in for us as a nation. And now that we see some tax reform, we see the opening up of capital, we see the availability of more liquid markets. Some people have said that regulation has impaired market liquidity. What's your position on that? I mean, is it making it, had it made it more harder and costlier to transact business?
So I think that there are instances where it has. I think that the Volcker Rule is an example of that. Right. Again, as I mentioned, economists will argue over measures of liquidity and how great the extent is of its effect on liquidity. Certainly practitioners believe it's been great, and it's inarguable that it's existent, and I think that it's unnecessary. I think that we can have an implementation of the Volcker Rule that is that doesn't have those costs, or at least reduces those costs. Liquidity regulation itself has also had an effect. As I indicated in my testimony, I think that we can and will and should give consideration to how to further tailor liquidity regulation along the scale of firms, because that also can have an effect that you're describing.
And as we talk about, and I think my colleague Ms. Moore talked about access to capital for small business, that to me is so fundamental to a regrowth of a vibrant economy. 30 years ago, when I started my law practice, I had very limited access to capital, and I had to actually go and borrow some from friends to get started. And granted, after the track record and solvency and the growth of my business came, well, the access to capital was there. Today, I'm not so sure we have that access to capital. Apparently, some former members of the Federal Reserve have dismissed concerns about access to capital and have expressed the current state of small business lending. For example, a September 2017 Federal Reserve report entitled Availability of Credit to Small Businesses cited a survey from the NFIB, which found that polls suggest credit availability is a relatively minor concern for small businesses. I don't agree with that. I think access to capital is one of the huge, most important concerns of a small business. During a March 26 speech, you discussed the findings of a survey published by the 12 Reserve banks. Can you tell us what that survey revealed in terms of access to capital for small businesses?
Well, I think that without getting into the terms of any particular survey, I think that I do think that lending to small businesses is an issue. And one of the things that I did earlier in my career was...
Is an issue as that there's a regulatory impediment to the access to capital?
I think that there is. Certainly at the community, I think that the cost of regulation on community banks has been an impediment. Community banks are an important source of credit for small businesses. Earlier in my career, when I was an investor in smaller banks, I was
and so the lifting of that regulatory burden would allow community banks the ability to lend more and in turn growing those communities, and in turn building a more vibrant and productive economy.
Yes, I believe that.
And we should be doing what is necessary to see that that's done.
Yes, we should. And some tailoring has happened. I think that there's more that we can do in order to reduce the burden on smaller institutions.
Thank you. And I've just got a couple seconds left, and I just want to reiterate what the chairman of the Housing and Insurance Subcommittee had talked about with regard to the sanctity of state-regulated insurance. I think that we, and I would hope that you would continue to advocate on behalf of our system of the state-based regulatory scheme, not only in terms of capital standards, not only in terms of solvency, but also in terms of consumer protection. So thank you for being here, Mike. Yield back.
Thank you.
Time of the gentleman has expired. Chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. Welcome, Vice Chairman Quarles. I would like to follow up on Ms. Moore's earlier question regarding the Volcker Rule. On January 19th of this year, you gave a speech to the American Bar Association Banking Law Committee, and you outlined plans to review and modify numerous bank regulations. During your remarks, you said, and this is a quote, "The relevant agencies have begun work on a proposal to streamline the Volcker Rule. It will naturally take a bit of work, but Volcker Rule reform remains a priority." I'm not sure that was the same response that Ms. Moore got. I just want to ask you about that. So the Volcker Rule, at least the core of the Volcker Rule, says no more proprietary trading. We had a disaster back during the housing crisis. A lot of these banks were engaging in speculative activity. Very, very highly speculative and risky activity in terms of credit default swaps and all that. A lot of these banks got in trouble. We had to bail them out. So we said no, the Volcker Rule basically said no more proprietary trading. Okay, so my question is, how do you streamline no more proprietary trading? How does that actually work?
Again, without wanting to, I don't want to directly front-run proposals that we're working on with 4 other regulators and that aren't yet
just conceptually then, don't go into their stuff, but just if it's a stop sign, don't proprietary trade, don't put the American taxpayer at risk. Mm-hmm. How do you streamline that? I'm just
the key issues will be around the definition of proprietary trading and providing enough certainty that institutions, in fact, know what it is that we will consider to be proprietary trading. So
you're going to change the definition of proprietary trading?
I think that there's scope to provide additional certainty around that in order to better effect the intention of the statute.
So what Congress was trying to prohibit was what I just described. Mm-hmm. So those bets, the speculative trading, the credit default swaps, all that, we were unwilling as taxpayers. We were unwilling partners on that activity, and we ended up when they lost money, the American taxpayer was a loser as well, even though we didn't authorize that, we didn't support it. Are we going back to that?
No, I mean, absent statutory change, the statutory injunction is clear, is that proprietary trading is...
You're telling me 2 minutes ago that you're going to redefine what proprietary trading is, and that makes me nervous because Congress spoke in terms of what we wanted to prohibit, and no is no. There's no streamlining no.
Right, and we're not proposing to say yes. The question is that if it's impossible to understand and to implement the definition of proprietary trading that the regulators have come up with, not the Congress. I mean, we took the statutory language and have turned it into a virtually, certainly a very difficult, some would say impossible standard.
We wanted it to be difficult. We did. We saw what happened. So I just hope you're not, you're not trying to disrupt the intent of Congress. We wanted it to stop, and it has stopped. So
I'm not even sure that you could say
if
that.
we want to have that debate, we think we're the ones that should have that debate about whether it should be relaxed or refined, but that's a decision for Congress. We certainly sent a clear message in Dodd-Frank and in the Volcker Rule that we wanted proprietary trading stopped. We wanted the American people to be out of that casino. We didn't want them, them being partner to that. We didn't want to have another bailout. Everybody on both sides said no more bailouts. That's enough. So we looked at the risky activity and we said we don't want any more of this. So I want you to just take that back, if you would, and incorporate that as one ingredient in your discussions.
Yeah, no, I deeply appreciate that. We're not seeking to undermine the intent of Congress at all.
Thank you so much. Mr. Chairman, I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Illinois, Mr. Holmgren.
Thank you, Mr. Chairman. Thank you, Vice Chairman, for being here today and for your work. I want to jump right into questions, if I might. I'm very concerned with the use of the current exposure method and capital requirements for banks who clear the trades of liquidity providers. As Chairman Powell noted last year, CEM, and I quote, he said, ignores whether a derivative is margined and undervalued, netting benefits, end quote. The current exposure method is insensitive to risk, so its mandatory use artificially caps market liquidity, particularly in large cap index options, which are crucial hedging vehicles. By making it more expensive to hedge, artificially constrained liquidity in S&P 500 index options has knock-on effects that increase overall market volatility, as we've seen in recent months. Rulemaking is the long-term answer, but that's a slow process taking years. Liquidity providers are dealing with this issue now. There's no reason to believe volatility is going to decrease anytime soon. What short-term steps can you take to fix current exposure methods' damaging effect on market liquidity? Short of rulemaking, what can be done?
Well, I think that the most effective method is for us simply to proceed in making that rule effective. We completely agree with your assessment of the difficulties that's caused, and I think that we should proceed apace and simply have the final rule that will address that effective.
Again, my concern is just that we get answers for people soon. The Treasury Department's October 2018 report on capital markets calls for a near-term solution of a risk-adjusted approach for valuing options for purposes of a capital rules to better reflect the exposure, such as potentially weighting options by their delta. Moving on, the Federal Reserve's current large financial institutions risk management proposal contains expectations for business line management that would apply to both business lines and critical operations. I believe this is duplicative. It is regulatory inefficiency that could be addressed. Why is the holding company regulator, the Fed, reviewing the same activities as the banking regulator? If the Fed reviews a bank's credit card business, for example, it's reviewing the same thing the FDIC has already reviewed. What's the justification for the Fed to conduct core business line reviews of activities contained within a holding company's bank subsidiary when those activities are already subject to examination by the bank's primary regulator?
Well, I think that to the extent that we do that, and frequently we ought to be able to rely on the bank's primary regulator. If there are cases where, for a particular supervisory reason we think that we should also be involved, we should do that in a way that doesn't duplicate the burden on the institution.
With respect to Volcker Rule reform, you've said publicly that it's important to, among other things, redefine the market-making exemption, which is admittedly an important issue, both for the banks that are market makers as well as for the broader economy. However, what can be done specifically for smaller banks, say those in the $10 to $50 billion range, to reduce the burden of Volcker Rule compliance? There are a number of regional banks in Illinois that fall in this category.
Well, that's one of the things that we're discussing among the four regulators. I think an approach might be either to be more clear about what it is that would be proprietary trading, and therefore that they can be clear that it's not something that they are engaged in, and supervisors can be clear it's not something that they need to look at because we have a very clear definition. There may be a way to look at the risks of particular institutions and determine that simply as an allocation of supervisory resources matter, the burden of proof in an examination changes, for example. But that you will be presumed not to, to be in compliance with the Volcker Rule unless there's a reason to think otherwise. There are a variety of approaches one could use.
My last minute here, I want to get into some fintech issues. Technology has significantly changed the way we do most everything, including access to financial products and services. Banks must comply with extensive regulations, especially in the post-Dodd-Frank regulatory environment, which other financial services companies may not be subject to. Are you concerned about non-banks, oftentimes with the competitive advantage of lower regulatory costs, offering nearly identical financial products and services without being subject to the same regulation? And if so, how would you address this in your role as Vice Chair of Supervision?
So I think that our regulatory system should not create unlevel playing fields. That's across a whole range of issues, whether it's banks and non-banks or different, banks and different types of regulated entities, small banks and big banks. I mean, we should not be creating an unlevel playing field. And so, on the specifics of how to address that with banks and non-banks, that then gets very complex given the limitations of our statutory framework that we have to operate under, but something that is a high priority for me.
Thanks, Vice Chairman. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
I believe Mr. Huizinga pointed out that the people don't know what the Fed does. That is not by chance, that is by design. The bank is an example of the fact that the elites in this country believe in democracy for every country in the world except ours. And it's undemocratic in at least three ways. First, both parties seem to have agreed that monetary policy is too important for politicians to talk about or for citizens to try to influence. Second, the Fed has a structure where the Class A voters are banks, not one person, one vote, one bank, one vote, or 1 billion, one vote. And then the Class B directors are selected by the Class A directors. So it's not, it's undemocratic in that it is partially bank controlled. And then finally, geographically, 1/5 of all Americans live in the western area, and yet that bank is not entitled to a permanent seat on the FMOC. 8% of Americans live in the New York bank area. That bank is guaranteed. So if you ever want an example in the United States, not of democracy, but of the Chinese system of government, the Confucian system of government, where learned, according to Confucius, men self-select a renewable group of people who have the mandate of heaven, though not the mandate of voters, there is no better example of the Chinese system in the United States. Mr. Vice Chair, I believe it or not, I have a question. Are there any financial institutions in this country that are too big to fail?
I think that we've made really tremendous progress since the financial
That was
crisis.
the exact answer your chairman gave until Senator Kennedy pushed him further and asked and pressed, is any single bank right now too big to fail? Do you agree with your chairman when he said no?
Well, I don't want to be in the position of disagreeing with my chairman.
You're supposed to. That's why we pay the salaries for more than one person at the Fed. If they were all going to agree, then any one of them would be superfluous.
But I do think that all of the large banks are much more resolvable than they have been before.
Are they too big to fail? Could a disaster at one bank bring down our whole economy, the way we saw in 2008?
Currently, I think that the system is much more resilient.
I didn't ask you that.
Failing.
Not going to let you slip away. Senator Kennedy was good enough to get your chairman to be specific in an answer. Is there any bank whose failure could bring down our entire economy? Yes or no?
We think that we've made sufficient progress.
That is not an answer. I know you've made progress. Is there any bank the failure of which could bring down our entire economy?
At the moment, I don't see how that could happen.
Okay, then would you support getting rid of the limited bailout provisions that were in Dodd-Frank, since if any one of those banks were to go under, we should, as good capitalists, simply wave and say, that's business. Toys R Us are going out of business, and America will survive, and you've described a situation where any one bank would pretty much have the same effect.
Well, in response to a previous question, someone asked what I had learned from the financial crisis, and the principal lesson I learned was the humility that we all ought to have around
We
our
should
judgments
all
of the future at any particular
be
time.
humble. I'm going to sneak in one more question. Back in the old days, there used to be banks that would make, to a small portion of their loans, would be prime plus 4, prime plus 5 loans, made to local businesses that you and I would agree aren't creditworthy enough so that a bank could make a profit with a loan at prime plus 1 or prime plus 2. Do your regulators allow banks to use 10 or 20% of their portfolio to make prime plus 4 loans to businesses like the pizzerias in my district, where that would be the appropriate rate? Or are those folks closed out of the banking system and having to call late-night television commercial lenders?
I hope that we don't have supervisors that are preventing that type of credit extension.
I'll talk to you privately. You do.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Okay. Thank you, Mr. Chairman. Thank you, Chairman Quarles, for being with us, for your leadership, and congratulations. In your March 26th speech at the Hope Global Forum's annual meeting, you stated, quote, "Loans entail high fixed costs that are roughly the same regardless of whether a loan is for $100,000 or $1 million, reducing the profitability of smaller dollar loans," end of quote. Has the composition of credit that is being offered changed?
That's an interesting question. I think that inevitably that evolves over time. I don't think that it's changed in a dramatically disadvantageous way.
Well, then are larger financial institutions playing a larger role in financing small businesses because of their ability to better eat the cost of higher underwriting standards?
That I definitely think is true. Yes, I do think that larger institutions are providing a larger share of the credit to small business than happened in the past.
Surely. Well, the Dodd-Frank's numerous regulatory rules have constrained the flow of bank credit, holding back small businesses that depend on bank lending, while large corporates benefit from the non-bank sources of finance. In your March 26 speech, you recognized that, quote, "For the economy, small businesses need adequate and affordable credit in order to form, grow, and succeed. Otherwise, they may underperform, slowing growth and employment." What are the side effects of reduced access to adequate and affordable credit for small businesses?
Well, I think small businesses, as we all know, are a principal engine of generating employment. They're an important engine of the economy, and credit to small businesses is an important element of allowing them to grow. Traditionally, that has come, a large portion of the credit extended to small businesses has come from community banks. Community banks are closer to the communities in which these small businesses reside, are able to make credit decisions that larger banks sometimes might not be able to make with respect to a particular borrower in a community. So all of those are issues that are having an effect, clearly.
Yes, sir, thank you. On another matter, as you are fully aware, that the Fed Bank of New York on April the 3rd began publishing its new reference rate, SOFR, the Secured Overnight Financing Rate, which is intended to be an alternative to LIBOR. Mr. Vice Chairman, has there been a robust cost-benefit analysis conducted by the Fed regarding the potential economic impact to consumers and commercial borrowers from shifting from LIBOR to SOFR?
So the shift, to the extent it happens, would be entirely voluntary. So this isn't something that the Fed is going to require. So while that is a question that we have looked at, we also think that, in determining whether any particular, institution would make the shift, that cost is something that they would evaluate as well. So since we're not mandating it, that's a different kind of analysis. Now, obviously we have been told that LIBOR as a potential standard will be disappearing. So I think that our, providing this alternative is an important option. I think it will be very useful, but it is voluntary.
Have you looked at the impact of this change would have on the borrowing costs for businesses?
In the context of LIBOR disappearing, and then I think that will be, I think inevitably the alternative of not having it available would be a problem.
Yes, sir. Well, since repo rates move in the opposite direction of LIBOR during the market stress, would any new systemic risk arise in the banking sector by shifting to SOFR?
That's a question that we have looked at. I don't think that we're increasing systemic risk. And again, when one considers the alternative of the sort of current widespread standard disappearing, the provision of an alternative is important, I think.
Have you all sought the input from community or regional banks concerning the potential costs associated in shifting away from LIBOR?
Yes, we have.
Did you find favorable input?
Yes, and as that process continues to move forward, we're continuing to evaluate input.
Could you give us a reaction that you've had from the smaller banks?
Again, our assessment in general has been that since the shift is going to be voluntary, each institution will decide of itself whether the costs outweigh the benefits.
Thank you. My time's expired.
Time of the gentleman has expired. The chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman. Vice Chair Quarles, I want to start by commending you for the posture you assumed earlier in your tenure by setting efficiency, transparency, and simplicity as guiding principles for your regulatory improvement agenda. The mistakes of the last 8 years demonstrated just how important it is that we have regulations that are straightforward and appropriately tailored. As you know, the implementation of the Dodd-Frank Act, through the implementation of the Dodd-Frank Act, insurance companies that have depository institution subsidiaries were brought under Fed supervision. This created a situation in which many of these insurance companies are supervised at the holding company level by both the Fed and state insurance regulators. This leads to duplicative supervision that is disproportionate to the risks that these insurance companies pose, and I would argue that this violates the principles of efficiency and simplicity. Would you support a more streamlined regulatory approach for these insurance companies that would uphold the state insurance supervisory and regulatory regime while right-sizing the Federal Reserve's examination authority?
Yes, the devil is in the details of that, but I have, I've spoken to a number of these insurance companies, and I think it's clear that the burden of our regulation is has been excessive relative to the scope of the issue. So I think that that's something that we need to work on. Now, as long as the insurance companies have depository institution subsidiaries, I think that that's something that that we need to have an appropriate regulatory relation to. But we need to do a better job of ensuring that that regulatory engagement is felt by the firms as proportional to the scope of the issue.
Well, I look forward to following up with you on that.
Yeah,
Thank you.
very much so.
As you know, the FSOC has begun work on reviewing the objective criteria used for designating non-bank SIFIs. I support that effort, and I look forward to seeing the formal rulemaking. Can you give us an update on the status of that project?
Not a satisfactory one beyond that it's underway, but I support as well the effort to look at an activities-based approach for designation, which is where the thrust of the thinking is going.
You mentioned the Bank Exams Tailored to Risk, or BETR, program for regional and community banks in your testimony. BETR uses financial metrics to differentiate the level of risk between banks before exams and ensures that examiners tailor their procedures to minimize regulatory burden for firms engaged in low-risk activities. I can see how this approach could make sense for all banks, not just community and regional banks. For instance, an institution that is not engaged in consumer activities should not have to go through the same examination process or modeling review of consumer losses as a bank that has a large credit card or mortgage business. Will the Fed expand this risk-based tailoring to supervisory programs for all banks?
So we haven't given consideration yet as to that particular program. However, the tailoring of supervision to the sort of character and risk of particular institutions is something that I completely agree extends along the spectrum of institutions from the smallest to the largest, and it doesn't stop at any particular level. And we need to be giving thought as to how we do that.
Before my time expires, I want to commend you for recognizing the negative impacts of the supplementary leverage ratio. I know that Congresswoman Maloney had touched on this, especially the effect on custody banks. As you know, the Fed is currently undertaking a rulemaking to alter the application of the enhanced supplementary leverage ratio. The rulemaking proposal says the following. Over the past few years, concerns have arisen that in certain cases, the standards in the ESLR rule have become a generally binding constraint rather than a backstop to the risk-based standards. Thus, although the ESLR standards provide incentives to maintain a strong capital base, the current calibration also has created incentives for banking organizations to reduce their participation in lower risk, lower return business activity, such as taking custody deposits, notwithstanding client demand for those services. This is an issue that we have discussed extensively at this committee. As you know, we unanimously passed a proposal to address this problem earlier this Congress. This solution has also passed the Senate. While I applaud the Fed for beginning to address this issue, I also want to reiterate my support for a legislative solution. With that, I would yield back to the chairman.
Gentleman yields back. The chair now recognizes a gentleman from Colorado, Mr. Tipton.
Thank you, Mr. Chairman, and thank you, Vice Chair Quarles, for being here today. First of all, I do want to commend you in terms of the comments that you had made to my colleague, Mr. Ross, in regards to the community banks and wanting to be able to see that more tailored to be able to create those access areas. But I wanted to go on a little bit of a different track in regards to some of the proposed rulemaking that's being put forward by the Fed regarding the 2-hour recovery time objective from a cybersecurity attack. In February of this year, you stated that you'd work with other financial regulatory agencies on harmonizing cyber risk management standards and regulatory expectations across the financial services sector. The Fed's proposal for the 2-hour RTO obviously differs significantly from the standards and principles that are established by other domestic and foreign regulators. As head of the Committee on Supervision and Regulation, have you studied the risks and benefits of the 2-hour RTO proposal, its lack of harmonization with other regulators, and where it's being exercised elsewhere?
So those are all important issues, and as part of receiving comments on the proposal, we will certainly take all of that into account. Given the importance of resiliency, the Fed at the time believed that that was an important issue to get comment on, but we will take into account the comments that we're receiving.
Great, yeah, I think some of the concern was simply the time frame, 2 hours, and to be able to have the recovery end of it, given all of the different challenges that were there. So we'll look forward to hearing back on that. Also in December, you'd stated that cyber threat to the financial system is a matter of national security. Assume that's still your position. Do you plan to review the Fed's proposals for cybersecurity?
Yes, yes. I think, as I stated a little earlier, I think that we really do need to focus our engagement in that area on cybersecurity to seeing how we in the bank regulatory community and across the government as a whole can really support the efforts of these firms to be resilient against cyber attack. And because it's such a difficult issue, I do think that a lot of our engagement currently is more focused on compliance than real resiliency. And I don't want to, denigrate the importance of compliance, but I think we can do more and better. It's a high priority for me.
Great, thank you. Governor Quarles, the Federal Reserve Board is making progress in simplifying the capital rules and stress testing requirements, particularly for our smaller institutions. I've heard positive feedback from the industry on these goals, but I've also heard some concerns that the evaluation of risk management can be subjective and that compliance requirements change depending on which supervisor is in charge. Are efforts being made to be able to evaluate the potentially modify current risk management expectations and supervisory practices to allow for improved effectiveness and greater reliance on the rule of law?
Yes, I think that, that obviously ensuring the sort of uniform application of principles across a diverse body of supervisors is a difficult management task, but it's one that, again, is a high priority for me and that we're working, and that we definitely are working on, both within the Federal Reserve and across the other bank regulators to try to ensure that we have more kind of predictability and consistency.
Can you give us a couple of ideas, maybe, in what when you say you're looking at it, how trying to be able to pursue that?
Well, some things that we have actually done about trying to ensure consistency. We do have a structure in place for the largest institutions that's designed to try to ensure consistency of supervision. With respect to smaller institutions, that's principally a matter of training, and so we regularly have, when there's a new regulation that comes out or new guidance that comes out, we have various training seminars for the supervisors. I meet regularly with the leadership in the supervisory function at the Fed to ensure that those messages are going down to individual supervisors. It's a blocking and tackling management function as opposed to a silver bullet. It's something we have to work at every day.
I appreciate that. That is probably one of the bigger issues that we're hearing out of our smaller institutions is the trickle-down effect. So obviously the training, we'll put in a plug for some of the legislation that we've passed through the House with a lot of bipartisan support to try and make sure that we're getting real continuity for the smaller institutions and the opportunity to be able to make those loans for small businesses. I come from a rural community, and that is a real challenge. Thank you for being here today.
Thank you.
Gentleman yields back. The gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman and Vice Chairman. Good to have you with us today. I'm glad to finally see a presidentially appointed and Senate confirmed Vice Chairman fill a long unoccupied post. It's been 8 years since Dodd-Frank was enacted, and only now is the economy showing signs of recovery in spite of the overall burdensome regulatory environment that we have, not because of it. The role you play as Vice Chairman for Supervision is crucial in tackling some of the regulatory issues that have been plaguing this economy for so long. I hope that you'll be a catalyst for change inside an agency that's far too long become immune to change and reform. Our economy is as strong as it's ever been thanks to this Congress and this administration's focus on deregulation and a modernized tax code that's propelling Main Street toward landmark gains. My first question, Mr. Vice Chairman, is we must protect small businesses and consider their credit needs. The 12 Federal Reserve banks recently completed a small business credit survey which concluded that credit needs continue to go unmet. As a small business owner myself for 47 years, I know all too well the difficulties some of these companies face. So now that Congress has passed tax reform to help spur the development of Main Street, what actions will you take to ensure that small businesses can have their credit needs met?
Well, I think the principal action that we can take, and we have begun this, there's more that we can do, is to reduce the burden on smaller banks, the banks that tend to provide this credit and that are best positioned to provide this sort of credit to smaller businesses. Through the AGRIPA process, for example, we have reduced some regulatory burden on the community banks. But that is something that we are always continuing to look at, are ways to reduce the cost of compliance and ensure that the regulations that we're applying to particular banks are appropriate to the activities they're engaged in and the risk that they pose, which for community banks is relatively minor.
Great. In your testimony, you state that the financial condition of the community banks also has strengthened significantly since the financial crisis. So I want to unpack that a bit because I know firsthand that the challenges Main Street has continued to face in the last 10 years. One credit union or community bank is going out of business each working day. This must be addressed, and these critical institutions afforded the relief necessary, which you've talked about. So as you examine ways to improve the effectiveness and efficiency of supervisory programs, How do you plan to ease the regulatory burden on the community financial institutions?
Well, I think it's through, a continuing examination of where it is that we are imposing costs that aren't necessary in order to achieve our objectives. I think that we can. I think that over the course of the last couple of years, I think that we have reduced those costs. I know, again, as I mentioned in response to an earlier question, when I was an investor in smaller banks, the level of that compliance cost was much greater than it had been in the past and was a significant factor in decisions. I think that's a little less over the last couple of years, and going forward, I think we can make it even less.
Well, that's important because it just hits their bottom line and keeps it from getting out in the system. So, yeah. As you reflect back on the regulatory actions of the Federal Reserve over the past 8 years, you've recently discussed the need to review the costs and benefits of past initiatives. While I understand the Federal Reserve is not like most other agencies who are required to adhere to cost-benefit analysis in their rulemakings, I'd like to see more consideration given to the consequences of the board's regulatory actions. So as you undergo the review of the effectiveness of past initiatives, what factors are you looking for, and will you make the conclusions of these reviews available to Congress to examine?
We're looking in general at, across a broad range of measures of effectiveness of kind of the core elements of regulation. And clearly a significant portion of that is the cost that they impose on institutions, particularly, both direct cost and then a broader concept of costs that are imposed on the system and on society. We're still determining, as this process goes underway, kind of exactly how we'll deal with the results and how we'll make the results public, but certainly that will inform our interaction with Congress and our public statements as to as we think about improving the efficiency of regulation.
Okay. Mr. Chairman, I yield my time back to the chair.
Thank you.
Gentleman yields back. The gentlewoman from Utah, Ms. Love, is recognized for 5 minutes.
Thank you for testifying today, Mr. Quarles. Last week, the House passed the Volcker Rule Regulatory Harmonization Act, which would exclude community banks from compliance with the Volcker Rule by exempting banks under $10 billion with limited trading activity. Does the Federal Reserve support exempting community banks from the Volcker Rule?
Yeah, I think if that's a decision that Congress makes, I think that would be entirely appropriate.
Okay, so you would support the, okay. Does the Federal Reserve believe the Volcker Rule is an appropriate or necessary response to the financial crisis, or do you think we needed to tailor it back a little bit?
So I do think that certainly the way that we have implemented the Volcker Rule, and that's less on Congress's fault than the regulators' fault, has been excessively burdensome. Probably the scope of the Volcker Rule limits our ability to really focus on what the Volcker Rule was trying to get at. I think that it does limit our ability to respond.
Would the Federal Reserve support other changes to the Volcker Rule, such as what we talked about, maybe even expanding the range of banks that are exempt from the rule, or even repealing it altogether?
Yeah, in terms of supporting them, I think that those are decisions for Congress to make, and if Congress makes them, we would have no difficulty implementing them. I don't think that doing that, obviously everything depends on the scope of particular proposals, but I don't think that doing that would create any risk to the safety and soundness of the financial system at all.
Okay, so it almost sounds like you don't really have an opinion about it. You're just saying we're going to take direction from Congress, whether it's repealed or not. I just want to get kind of some expertise and experience. Would you support expanding the range of banks that are exempt, or just leaving
yes, I don't think that doing that would create any sort of financial stability risk at all.
Okay. We're also learning more and more about the other unintended consequences with the rule. One that has come up has to do with non-financial companies that own depositories, such as ILCs or unitary thrifts. As the Volcker provision is drafted, if a non-financial company owns a depository, the Volcker requirements apply to all their operations, even those not engaged in any financial services. This means that non-financial companies' ability to carry out some basic risk management could be seriously impacted. Do you believe that the intent of the Volcker provision was to apply it to the non-financial affiliates of an industrial company that owns a depository?
I'm not sure whether that's whether that was the intent of the provision, but it may be what the statute says. That's among the issues that we have to deal with in the current statutory language of the Volcker Rule.
Okay. The health and the viability of industrial banking sector is something that's really important to me. As a representative from Utah, I can attest to the importance of our ILCs, the vitality of our state's economy, the size and strength and diversity of our state's banking sector, even to the health of our nonprofits, which benefit not just from the financial contributions, but also the intellectual capital that they are able to draw from their colleagues in the banking sector. It was a big loss to our state when GE decided to give up their banking charter due to the current regulatory environment, including the Volcker Rule. I would just be really interested in your thoughts regarding industrial bank sectors. Have you had a chance to review the safety and soundness records of the ILCs at all?
As a citizen of Utah, I'm very familiar with them. It hasn't been and I'm familiar with all of the facts that you cite, and they're all true and meaningful. It hasn't been a project of the Federal Reserve up to now to kind of consider our regulatory system and how that applies to the ILCs, but I am very aware of the importance of the issues that you're stating and the importance of
So you would agree that ILCs have been a stable source of capital in our communities, even during the financial crisis?
Yeah, that certainly was my experience, yes.
Okay. Thank you, Mr. Chairman. I yield back the rest of my time.
The gentlewoman yields back. The chair recognizes the gentleman from Arkansas, Mr. Hill, for 5 minutes.
Thank the chairman. Thanks, Mr. Quarles, for being here. I want to echo Chairman Hensarling and Chairman Luchtemeyer's comments about cost-benefit analysis. I noted that back during DISCO days in 1979 that the Fed agreed to abide by OMB's cost-benefit analysis rules, but really hasn't, as a general matter, over that 35 years. So I was really heartened by your speech in January where you thought cost-benefit analysis was important and you've set up a group to look at policy assessment. Does that imply that you're supportive of a regular look at all Fed rules on a cost-benefit basis?
Yes, I think that we need to do a better job of that. We haven't decided as a board kind of exactly how we'll implement that, but I think that we can do a better job. I think that's evident.
And I think just from my past experience of being in the regulated industries for those same 3 decades, this issue that economists frequently look at marginal cost of a rule, but not at average cost, not at the cumulative cost. And so this idea of looking at compliance costs by bank size on a percentage of average assets or percentage of pre-tax earnings, I think should be part of that cost-benefit analysis and not just look at the particulars of the rule that a group of analysts are considering. It's the idea that it's the old expression of the final straw that breaks the camel's back. Let's measure the whole pile of straw and how the marginal rule impacts it. So thank you for that. Recently, I was looking at FINRA's a rule that's going final with FINRA Rule 4210, which has to do with mortgage-backed security agency securities and putting up margin on those securities. This is something the Commission's asked FINRA to do, and the SEC has approved this rule, and it's going to go final. But from reading it, it appeared to me to be 2 issues. First of all, this says that if we're doing a when-issued mortgage-backed securities pool, that during that 30-day when-issued basis, we'd be putting up margin on those securities based on a mark-to-market, which I understand. And this is integral to every consumer in our country because that's how we get a 60-day lock, our individual home mortgage, which is very important to consumers. But in looking at this rule, it appears to me 2 problems with it, and I'd like you to look into it. One, it appears anti-competitive to me. for a bank-owned dealer has an advantage over a non-bank affiliated broker-dealer. Why? Because if FINRA just applies to the broker-dealer, a broker-dealer that has a bank affiliate could simply move this when issued business over to the bank, therefore being anti-competitive with non-bank-owned dealers. And I have a problem with that. I think that's unfair in public policy. And secondly, you may want to have a little jurisdictional concern, because I'm not sure that the SEC has the authority to regulate margin in agency securities. I think last time I checked, that was a Federal Reserve prerogative. So would you commit to me that you'll look into this rule and see how we can assure a level playing field in the agency market?
Yeah, absolutely. I think that, you know, that needs to be a very high principle in regulation generally, is that regulation should not be sort of tilting a playing field one way or the other across a whole range of issues.
Appreciate that. And in the time I have remaining, another issue I think that's I think the Fed should weigh in on is this issue where under Dodd-Frank, the TLAC process, putting up abundant capital to resolve a potential bank crisis, I think now appears to me to be in conflict with our new and tax reform and tax cut package that we're very proud of in the Congress. We believe this is why CBO says we're growing at 3.3% now, a big increase from the past decade, and that's great for all Americans. But part of that was, as you know, on the international tax regime, this base erosion anti-abuse tax feature of the tax reform bill now appears to me to be in conflict with financial services policies on TLAC. Are you familiar with this, and have you talked to the Treasury about this potential conflict?
Yes, so I am familiar with the issue. I've talked with the affected banks, with the Treasury, you know, what we're trying to do, or asking the banks to do, is to first quantify the issue, because quantifying it is very complex, as you know, because it depends on their whole tax position. And that has taken them some time. We're beginning to come back with some estimates now from at least some banks of what they think the quantifications are. And then the question is the best way to do that through a Treasury rulemaking, through thinking about Federal Reserve regulatory policy, and we're just beginning to start working with the Treasury on that.
Good. Well, best wishes, and please keep us apprised on your thoughts there. Thank you very much. I yield back, Chairman.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Loudermilk.
Thank you very much, Mr. Chairman, and thank you for being here with us. A couple areas I want to talk about with you is first, a 1977 bill, the Community Reinvestment Act. To start with, then I want to talk a little bit about cybersecurity if we have time for it. But as you know, this bill was implemented in 1977, and I, as many others, believe it's time to revisit and revise this bill. And last month, I wrote a letter with Mr. Tipton and Mr. Lukemeyer to the 3 banking agencies and the Treasury Department about modernizing the implementation of the CRA. And we received back from the Treasury Department, which recently released its recommendations for CRA reform, and the OCC will be doing the same. And the FDIC chairman, Mr. Grunberg, wrote us back and said he agrees that we need to revisit this. And the 3 areas that I think that we've been focusing on, I think we need to pay attention to, is first, the taking account of the recent developments in fintech. 2 is being transparent with banks about which loans receive CRA credit. And the 3rd is giving banks timely CRA exam results. And so my first question is simple. Do you agree that there's a need to revisit the implementation, particularly in these areas?
Very much so. I mean, as you've noted, it's a law from 1977, and the world is very different today than it was in 1977, and achieving the same objectives will probably require different measures now than it did then.
And I'm often reminded when I go back and I watch movies from 1977 how much has changed. And it's not just the hairstyles, but the economy and technology has changed, and we have been extremely slow in keeping up with technology and the regulations for that. And so I appreciate your answer. Kind of follow up on that, do you think the CRA can be modernized without detracting from its core purpose?
Not only without detracting from its core purpose, I think that for it to achieve its core purpose in the modern world, I think it can better achieve it if we sort of take a fresh look at it.
Well, I appreciate it, and I agree with you on that. So I look forward to working with you as we do this. Kind of shift over a little bit on cybersecurity. I spent 20 years in the IT business. This is an area that's very important to me. And I know during a speech to the Financial Services Roundtable in February, you stated that you support the private sector's efforts to harmonize cybersecurity efforts across financial services industry. And I agree with that. But I also think there's a need for federal regulators to harmonize the many overlapping and sometimes conflicting cybersecurity standards that are applied to private sector companies. Especially a lot of banks will have multiple cybersecurity requirements, or financial institutions, I should say, that are differing from the different regulating agencies. In fact, I had one tell me one time, well, if I'm in compliance with regulator A, I'm out of compliance with regulator B in certain instances. What's the Federal Reserve doing to coordinate these cybersecurity supervisory activities with the other regulatory agencies?
So there are some standing processes, kind of interagency processes that are intended to help coordinate that, that are focused on the IT infrastructure exams and the infrastructure of the financial system generally. But as I've indicated, I do think that we need to, in those processes and within the Federal Reserve, we really need to kind of rejuvenate the way we're thinking about it and focus on kind of real resiliency and what we can do to support that as opposed to pure compliance.
So do you think there's more that we can do to coordinate between the various agencies? Like you say, when you have conflicting requirements, it actually harms cybersecurity than actually strengthen it. So I think
absolutely
the same thing that you were saying about the CRA, I think we can apply to cybersecurity. Last question. In your testimony, you said that you're focusing on mitigating cybersecurity risks to financial institutions. Can you just hit on a few of the things that you're doing in that arena?
Right now, the principal effort is in these interagency discussions to think about, where are the real risks in the system. So it's kind of behind the scenes to figure out exactly what we ought to be doing, and then we work on how to affect what we ought to be doing. They're difficult questions, and we are still working on them, but a very high priority.
All right. Well, thank you. I see my time's expired, and I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Ohio, Mr. Davidson.
Thank you, Chairman, and thank you, Vice Chairman Quarles. I really appreciate your testimony today, both written and in the Q&A session. So thanks for helping with the transparency that is part of the role. But I'll confess that the average constituent, the average person who's maybe looking at the clock saying, hey, I'm coming up on my second shift job, catching lunch or something, they may know that the Federal Reserve's out there. They may know that the Federal Reserve Chairman deals with setting interest rates. They might not differentiate that as monetary policy. Could you succinctly describe in a basic way where the distinction between monetary policy and regulatory supervision is drawn?
So I'll try to do that. So I'll try to do that succinctly. But our supervision because the two are related in important ways, and that gets very complicated to try to describe. But our regulation of the financial sector and of the banking system is the development of rules to ensure the safe, sound, and efficient operation of the system. And then we have a supervisory function where we examine all of the banks that are subject to our jurisdiction to ensure that they are complying with the rules and operating in a safe, sound, and efficient manner.
Thank you. And having been the first person to fill this role, I appreciated your testimony earlier with Mr. Lukemeyer when he was differentiating guidance from rulemaking. Mm-hmm. And of course, rulemaking is generally subject to more oversight from Congress, and we kind of struggle with the guidance. And frankly, there's very little accountability for what guidance is given, except kind of reactionary after the fact, and then it's hard to substantiate, and it's finger pointing, no, it didn't, yes, he did, kind of events. But it has a profound impact on the economy. In your role, how do you see you personally and your team being able to contribute to clarity around that?
So, I think that there ought to be, transparency in all of our processes ought to be something that we, that's a high priority for us. and it has been a priority, but I think it's becoming a higher priority. And that means that when we're taking an action that we think is going to have the effect of a rule that we intend to apply as a rule, then we should take that through a fully APA compliant process and seek notice and comment and put that forward as a rule. And perhaps in the past at the margin that sometimes hasn't happened. I mean, that distinction has been blurred. I do think there's a role for guidance. I don't think that, it's never the case that we'll put out guidance. The banks ask us for guidance, right? Once we've gone through the complex
We
rules.
appreciate that distinction from, the Fed's activity in the CFPBs, for example, where they don't want to be accountable for even giving guidance.
Precisely.
Yeah.
And with respect to our guidance, I think that we can be, as opposed to that, which sometimes in the past, that's less in the case in the recent past, but sometimes in the past has just gone out to the examiners and the banks. I think that we can go out for comment on guidance, even when something's not a rule. I think that we benefit from that process. It's not just it's not just a question of being fair to the regulated industry. It's not just a question of being accountable to the public. It's also a question of improving the content of what it is that we do by getting as much comment on it as possible.
Well, thank you, and thank you for that role and the ability to protect the average American in their safety and soundness of the financial markets in that way. And Chairman Barr alluded to a bill that I've introduced that would provide a way to do more of that accountability through putting the regulatory side, the supervision side of the Fed on appropriations. And so I look forward to working with you and Chairman Barr on that as you committed to do, so thank you. Another important role is the engagement with international agreements. And I'll confess I've been very concerned about the previous path and personally affected by some of those decisions. How do you plan on having the Fed represented at these international accords in the future, given your leadership role?
So, as I've indicated, I do think that it's in our interest. I know that there's been frustration with these bodies in the past. I think that our engagement with them is in our interest, in part precisely because of that reason. We have, particularly for our institutions that do operate globally, we don't want the decisions made in those bodies made without our strong and effective engagement. I think that we need to argue for them to continue their evolution towards more transparency. I think they have been. I think that as we implement their rules, we need to be transparent about how we do that.
Thank you. My time has expired, and I yield.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Budd.
Thank you, Mr. Chairman, and also thank you, Vice Chairman Quarles, for coming today, and again for your service, a breath of fresh air. My questions are about a smaller part of your portfolio, but no less important. It's about insurance oversight.
Mm-hmm.
So specifically, I want to talk about the ongoing work on the international capital standards that are being developed by the International Association of Insurance Supervisors. So in November of last year at a meeting in Kuala Lumpur, IAIS announced that it was moving forward with an ICS version 2.0. That will be very similar to European solvency regulation and will use European accounting rules and European capital resource determinations. So in my view, this European-centric approach is unworkable for the U.S. insurance regulatory system. So with that being said, my first question is, do you believe existing state-based capital requirements promote the solvency of U.S. insurance companies?
Yeah, I think they do, yes.
Okay, very good. Last week, I received a response from Chairman Powell to a letter I sent him on this same topic. Specifically, Chairman Powell cites two rationales for the creation of ICS. One was to provide a level playing field. The second was to prevent regulatory arbitrage. So while I know the response I received was not from you, you and Chairman Powell work very closely together on these. And so I have two brief questions on Chairman Powell's response. First, why is capital the only component when EU regulators and EU insurers talk about a level playing field? And I will go on. So does Europe have the robust consumer protection and insurer resolution mechanisms that we have here in the U.S.? And where is the level playing field on these very important topics?
So I agree with you that we need to be thinking about a level playing field across the whole regulatory regime.
And not just with capital standards.
And not just with capital, certainly, yeah. That ought to be an important part of our general engagement.
Could you elaborate other areas where we would want to have a level playing field?
As you've indicated, I mean, I think that all the elements of a regulatory regime, affect the burden and competitiveness of an institution, and it's in our interest to look across, all of the elements, and different fora. There may be different fora that are the right places to try to push those arguments, depending on different types of regulation. But it's in our interest to ensure that the whole playing field is level.
So beyond the capital standards, insurance and consumer protections and insurer resolution mechanisms level the playing field there as well? It's fair to say. So next question, should the Federal Reserve as a prudential or safety and soundness regulator be concerned about an international level playing field? Isn't that more of a focus of trade policy and not just monetary policy?
Well, as a financial regulator, though, I do think that it is, that it gets a little weedy. Our trade policy generally sort of stands back. Our trade representative and trade negotiation stands back from financial regulation, and those are sort of separately negotiated. Those issues are separately negotiated. Because we do have an interest in ensuring that our internationally active firms are sort of treated equally and not subject to differing rules in differing jurisdictions in ways that might be deleterious to them. So I do think that we have an interest in engaging in those fora to try to ensure level rules in those areas, and I think that it is appropriate for that to be done in the financial regulatory sphere, both with the Federal Reserve and with other participants.
Appreciate the clarification. Mr. Chairman, I yield back. Thank you.
Would you yield to the chairman?
I yield to the chairman.
Mr. Chairman, under the living will requirements, and I think we may have touched upon this once, you are really given, the Fed is given kind of unreviewable discretion to really fundamentally restructure a number of private businesses that seemingly lack kind of objective standards. And so the entirety of the annual living will process is all predicated on a quote-unquote credible plan, whatever that is. So you've talked about transparency. What is it you can do to increase transparency to the living will process? And with respect to having to do this on an annual basis, do you have it within your power to do it on a less frequent basis?
So with respect to transparency, I do think that, as with many of our regulatory and supervisory issues we have with firms, I think that we can just be more interactive and open about what our expectations are, get more comment from them about our expectations, ask more questions. All of that's something I think that we can do better. On the frequency, yes, we do have it in our power to have these assessments done less frequently. And I think we're probably at a time where it's appropriate to do that. Whatever the merits of the prior process of restructuring, it's largely complete.
Time of the gentleman from North Carolina has expired. The chair now recognizes the gentleman from Tennessee, Mr. Kustoff.
Thank you, Mr. Chairman, and thank you, Vice Chairman Quarles, for being here with us today, this afternoon. I'm going to go a little bit more broad, if I can, maybe than some of the other questions. Obviously, the Federal Reserve, and in that speech, the way I read it, you acknowledge that the small business credit needs are in many instances not being met. Do you believe that there's a need to reduce the regulatory burden on our small community institutions so that they can continue to meet the needs of our small local businesses?
Yes, I think that there's a need to do that, and that it's important for us to address it.
And you talked in your speech about the easing, and in particular, are there particular types of companies that you've identified or that you would identify as having the most difficulty finding adequate access to credit?
So I'm sure that that study has been done. I don't know the facts, but I can certainly get them for you as to our assessment of whether there are, particular companies that have the most difficulty getting access to credit.
Thank you very much. As it relates to fintech, can you explain, if you would, how the Fed carries out a supervisory role in new and expanding markets to protect consumers from fraud and cyber attacks?
With respect to fintech, our supervisory relationship with fintech principally comes from where the fintech firms connect with the directly regulated financial system, with the banking system, which most of them do. They receive their funding or access to the payment system through a regulated bank, usually in one place or another. And when they do that, then we both supervise the bank as it engages with the fintech company, and in certain cases we have the ability to look at the fintech company and its connection to the bank, and then we look and determine the compliance of that activity, both with safety and soundness regulation as well as with consumer compliance regulation.
Thank you very much. And I yield back the balance of my time. Thank you,
sir. Would you yield to the chairman?
I yield to the chairman.
I thank the gentleman for yielding. Chairman Quarles, back to the living wills. As I understand it, Section 165 of the Dodd-Frank Act would allow you to publicly disclose the assessment framework. Is that your understanding as well?
Yes, I think that we could disclose it.
Okay. Are you familiar with H.R. 4292 of Congressman Zeldin, the Financial Institutions Living Will Improvement Act?
I am.
Okay, well, it would do just that. And are you familiar that this bill passed the House 414 to 0?
I knew that there was a bill that had, and now I know it's that.
You might want to just take my word for it.
Exactly.
Anyway, please take this as a very strong suggestion of the House of Representatives. So you do have the authority to publicly disclose this assessment framework. The House unanimously is suggesting that you do that. I hope that you will give it careful consideration. In addition, I believe Section 165 of Dodd-Frank would also allow the Federal Reserve to provide feedback on Section 165D living wills. Is that your understanding as well?
Yes.
And I suppose you could do this in a time frame of, say, 6 months?
That would be possible.
Okay. Just for your edification, you will also find this in H.R. 4292, and I would suggest that the Fed take a very serious look at doing just that. Time of the gentleman has expired. The chair now recognizes the gentleman from Indiana, Mr. Hollingsworth.
Well, good afternoon. Thank you so much for being here. You've reached the end of the line here, like Chamberlain on Little Round Top, right? Well, I wanted to reiterate a few things. I know you've talked a lot about cost-benefit analysis, comprehensive analysis, the importance of that overall, and obviously I'm working on a bill specifically that we've dropped that really helps and drives the Federal Reserve to do cost-benefit analysis where their regulations are in excess of the international standard. And just the statement that says, look, hey, if it needs to be in excess, then it should be delivered through a cost-benefit analysis. People deserve to know the reasons why we've done this, right? And if the analysis itself doesn't bear out that it should be in excess of international standards, then we want to know that as well, right? And so it does nothing to force it to match international standards, does nothing to change existing standards, but just as you've said in your testimony, as you've said in the Q&A period here, how important transparency is, it really helps with that process. So I'd love it if you'd take a look at that as well.
Absolutely.
On a very, very different topic, I also want to talk about GSIB surcharge and how important that is. And I'm actually reading a book right now that talks a lot about Wheeler and Feynman's collaboration on quantum mechanics. And one of the things that really stuck with me was they said the hardest part about quantum mechanics is the constants change as well as the variables, right? And that brings me back to some of the coefficients in the method too, right? They've been in place and they've been set since 2015, but the economy, the world, the environment, the risk profile have all changed since then. And so I wondered if you might comment a little bit about the potential to update some of those coefficients to reflect the new reality, and specifically with regard to economic growth, right? We don't want our firms to be penalized because the economy's grown, because the world's gotten bigger. And I wondered if you might comment on that a little bit.
So I think that those are very good points. I think those are things that we have to look at with respect to the calculation of the GSIB surcharge in general. You know, the original calculation of that was made, a number of years ago, and in part in relation to the living will process that we've just been talking about. If we believe, which I do believe, I think I think it's generally accepted that has resulted in an improvement in resolvability of the firms, then that means that the consequence of their default is less. And the reason for the GSIB surcharge is precisely our assessment of the heightened consequence of their default. If we have reduced that consequence, we ought to be able to think about. Now, I don't know exactly, what the size of that effect is, what the outcome of that would be, but that a process of thinking about it is appropriate now.
Yeah, and we should reflect that with the reality that we see on the ground. Like you said, not only with their lowered risk profile, but the enhanced economic environment as well. Ultimately, we haven't slaughtered the business cycle, right? But we want to make sure that at every step of the way that the coefficients themselves reflect reality. Because if they don't, they start to drive reality, right? And cause firms to make decisions that might not be in the best interest of a stable, safe, secure, but also efficient financial system, like you've pointed out. Specifically, one of the things that I wanted to talk about within the method two and within the coefficients is how the short-term wholesale funding is measured and how certain liabilities are treated. And just wanted to draw your attention to those as well. Obviously, like you talked about, I think in your written testimony, you even refer to the great changes that have been made over time, specifically with the GSIBs and in reducing their reliance, but making sure that ultimately we have that reflected in the equations themselves, and appreciate your work. And then, as David mentioned, how important it is to overall kind of step back and how much we appreciate the work that you are beginning and really looking at, and as you say in your testimony, the fact that it's not incompatible to say we want a safe and secure system, but we also need an efficient, effective system as well, and making sure that those two go in hand. And I really appreciate the fact that you've been willing to look at so many things, recalibrate so many things, because I think this is very much an iterative process and making sure that the things that we have done in the past, whether that's Congress or regulators, haven't had a deleterious effect either on the economy, either on credit availability, but also on U.S. firms' ability to compete around the world. Because ultimately, financial services is something we do exceptionally well in this country. I want to make sure that that continues to be the case and that public policy doesn't stand in the way of that. So thank you for being here today. With that, I'll yield back, Mr. Chairman.
Would you yield to the chairman?
I would indeed.
Mr. Chairman, going back to the CCAR process, recently the Fed announced that it would no longer object to a company's capital plan based upon the qualitative deficiencies for banks under $250 billion. Is that correct?
Yes.
So under Section 165 of Dodd-Frank, you also have the power to do that for all banks. Is that correct?
That's also correct.
Are you considering doing that for all banks?
We are.
Excellent. The time of the gentleman has expired. There being no further members in the queue, I would like to thank the witness for his testimony today. Without objection, members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. I would ask Chairman Quarles that you please respond as promptly as you are able. This hearing stands adjourned.